Hit it.
It's April 24th, 2020, episode 77. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we are pleased to welcome Chris Sommers from Unhedged.com. Chris has a fascinating career that has ranged from investment banking at storied Wall Street dealers to working at Greenlight Capital, where he's part of the Lehman Brothers short-selling campaign. You don't want to miss this interview. Then we have Harris Kupperman back for Kuppy's Corner, and we ask him, why haven't the tankers rallied?
We then have Rob Koyfman joining us to talk some charts. We look back to this week in trading history. Then Kevin put together a great WTF clip for of the week, and we finish with the top 3 things to watch next week. Let's get to it.
Joining us now is Chris Sommers from Unhedged.com. Chris started his career through a variety of different internships while attending university. They ranged from working on the CBOE options floor during the heyday of the dot-com bubble to investment banking at prestigious Wall Street brokerage firms. Eventually, he ended up at the famed hedge fund Greenlight Capital, where along with his boss, David Einhorn, he was part of the Lehman short campaign that is now permanently chiseled into Wall Street lore. Since then, Chris has gone on to start his own research web service called Unhedged.com, which is attempting to eliminate the duplication found in much of financial research. Chris, welcome to the show.
Thank you. Great to be on.
It's going to be a lot of fun. We were already chatting about kind of your life and your stories, and I'm looking forward to this. Why don't you tell us a little bit about yourself? How did you end up on Wall Street and actually in Chicago as well at the CBOE? Where did it all start?
Sure. So I grew up in Southern Illinois in a town called Belleville, which is next to East St. Louis, kind of a suburb of St. Louis. Pretty economically depressed area. It was not the most fun place to be. It wasn't the easiest childhood or whatever. So I wanted to get out of there. And when it came time to apply to colleges, the guidance counselor said, "Oh, why don't you look at University of Illinois or University of Iowa?" And I was like, "Look, lady, I'm getting as far from this place as I possibly can." And so I applied to a bunch of schools on the East and West coasts. Had never visited any of them, never even really heard of a lot of them. I just knew I needed to get as far away as possible. So I ended up applying early decision to Dartmouth in New Hampshire, got accepted. My parents said that we couldn't afford it. And I said, well, it's my problem now because I'm going either way. So anyway, left there, thank God, and ended up at Dartmouth, which was a great fit for me. I had an awesome time. Started out in computer science, had a very bad professor, had never even heard of the field of economics before. It doesn't really, in Southern Illinois, no one talks about economics. But some friends were in the class, so I took it. And it was a Latin American transfer assistant professor who was a visiting professor, and he taught the whole course using every analogy of supply and demand, whatever it was in terms of beers and cheeseburgers.
Now that's a selling point for me.
That's right.
He was a huddler. He was one of the original huddlers.
Yeah, so he made it really engaging and immersive. So I kind of fell in love with the way that he did it, and I've always had a mathematical background. I was like the math team in high school, and I won the Illinois State math competition in, 1998 or whatever it was back then.
Holy shit.
So I've been I'm a math lead, a big math geek. And I was always been a computer geek too. I actually, in high school, I started a website called virtualmall.com. I ended up losing out to a guy named Jeff Bezos with Amazon, but the idea was kind of similar. But I was only 17 and I was a little undermanned, and Jeff Bezos ended up becoming something. Anyhow, in college, as I pursued the course of economics, I learned about the stock market and all that stuff, which I don't think I'd ever even heard of the stock market when I was in high school. So I ended up doing an internship on the floor of the Chicago Board of Options Exchange. Chicago's about 6 hours north of me. Kind of a funny story. I didn't have a car, and I had to steal my dad's car, and then he threatened to call the police on me. But I knew I had to get a job to start building up my resume, and I had to do whatever it would take. So I got this internship on the floor of the options exchange, and it was great because in the late 90s, was like the peak of activity on the floor. It's like what you see in the movies with everybody shouting and going crazy. And it was at the same time as the tech boom. So the biggest and most active pits were like Microsoft and Intel. And it was just mayhem down there. And there was like 25-year-old kids making 800 grand, $1 million a year, like for a few years in a row. So it was kind of like party central. So it was a lot of fun. The internship didn't pay anything. It only paid $10 an hour. So I had to sleep on the floor of a guy's studio apartment. So it's him and me on his floor. But do whatever it takes. So that experience helped me have a story to tell when I wanted to kind of apply to the real big boys. And then I ended up getting an internship at Solomon Smith Barney, the investment bank that Citigroup later bought, in their mergers and acquisitions department. And I, worked as hard as I could there. I knew it was my only way out of not ending back up in Illinois, Southern Illinois, was to get a good job at one of these good firms. So I just knew I would have to do whatever it took. So that was a great experience. I'm still friends to this day with basically everybody I interned with back then. After that, I had an internship. Dartmouth is on quarters. So I had an internship in the fall, I think was Solomon Smith Barney. And then it might've been the spring. I don't remember anymore. And then the following summer, I interned on the high grade credit desk at Lehman Brothers. That was not as good of an experience. I didn't really like the guy I was working for. I was trying to learn a lot, and I wanted to immerse myself and learn about like credit and bonds and all that. And they were more interested in me like fetching lunch and getting coffees and stuff, which was actually the exact opposite of my experience at Solomon Smith Barney, where I told my boss, like, hey, I want to learn as much as I can. And I bought these books on like taxes and all the weird merger stuff, reverse Morris Trust, all this like funky stuff. And they loved that an intern was getting into that stuff. Right. Whereas at Lehman Brothers, I brought this bond book to work, and he's like, oh, you don't have time to read that book. And I'm like, I don't do anything all day here, dude. Like, what am I supposed to do? He's like, oh, go get lunch. I'm like, okay.
Were you just on the regular, like the junk bond desk, or with the high yield?
We traded. It was high grade, so we mostly traded preferreds and corporate bonds of banks and things like that, AAA credits.
Oh, I see. Okay, that's what high grade means. I didn't understand that. Okay, I get it.
Yeah, they called it high grade.
So it's really. It's investment grade. Like, is it? How does it differ from investment grade, or is it investment grade?
It is. It's investment grade, but it's the top end of the investment grade spectrum. It's AAA stuff, so maybe some.
Oh, I get it. Okay, fair enough. So you had a bad time at Lehman, and then you went back to school, and now upon graduation, where did you end up?
So I went back to Solomon Smith Barney, which had subsequently become Citigroup. And at that time, they'd actually disbanded the M&A group into industry verticals. So I went into the group that my former staffer from M&A went to, which was the consumer group. So that's consumer and home building. I liked it. It's when you're young and you need to learn a lot and you need to like figure out how to use Excel and read company filings and all that. It's a crash course, and you work 80, 100 hours a week. So you pick it up pretty quickly. So anyhow, I was lucky enough to be chosen to teach the incoming class the following year of first year investment bankers, which is a great gig. I basically got the summer off. I went from 100 hours a week to 35 hours a week. And part of the job is you've got to take these kids out and show them a good time, get them drunk, and they give you like a corporate credit card.
Oh, twist our arm. That sounds horrible.
Yeah, that's right.
Yeah, so that was great.
Did you feel a little bit like you were taking the lambs to the slaughter, though?
No, everybody knows what you're getting into. There's no shortage of horror stories, and if you've made it far enough to get a job there, you kind of know.
Right. Okay. So from then, was M&A for you? Like, did you enjoy that, and did you end up staying in mergers and investment banking?
No, I after that summer, it occurred to me like this is not a career that I'm interested in doing any longer, really. I I have a funny story about that too, actually. But so I started looking around for a new job, and the choices back then, most people were doing private equity, but I was much more interested in the stock market. So hedge funds were just kind of becoming a big thing. So I had a couple interviews early on that didn't really go well because I didn't really know what I was talking about. But then I kind of got up to speed with the process. And I ended up getting a job offer from Greenlight Capital and Third Point Capital at the same time. And I didn't know at the time that David and Dan Loeb and David Einhorn were good friends. And so I tried to play their offers against each other. And then I think it was Dan. Dan called me up and he said, "Hey, just so you know, the offer is take it or leave it. It's not going to change. I talked to David and I know you're trying to do something here." So, I had to make a decision. And, at the time, I think the culture and Dan Loeb was kind of probably a better fit for me, for my personality. But my impression was that David and Greenlight had a more academic or I don't want to use, it's not challenging, but it was a different process that I thought would be harder for me to adapt to. So I chose what I thought would be harder for me. And I ended up taking the Greenlight offer.
Wow. And because I think isn't Loeb a little bit more of a shark than of course Einhorn is a shark too, but Loeb is the sharky of the sharks, right? And not only that, I think he's a little more aggressive than, David seems like he's more of a friendly kind of nice guy, whereas Dan, from what I've read, seems to be more of a in-your-face kind of guy.
Yeah, back then was when Dan was writing a lot of 13Ds, and he was activist, and he had some aggressive shareholder letters that I think helped build that personality. A classic one was when it was a Star Gas, I think. They took an activist position in there, and Dan wrote a scathing letter, which was filed as an exhibit to 13D, so the whole public could see it. And he said he tried to call the CEO, and the CEO was, quote unquote, on the golf course. And then Dan went into this blistering tirade about, what are you guys doing? And, when I'm through with you guys, you'll have plenty of time to be on the golf course because you won't have a job.
I think I remember that one. There was a very famous one like that. I do remember that. Anyway,
yeah, but
so
they're both good guys, and Dan's a great guy. With Greenlight, we ended up doing a co-investment with Third Point in an ethanol company where we built 2 ethanol plants called Biofuel Energy. So I was on the board of that company with Dan. So, the relationship with him has continued. I mean, we're still friends to this day, but I got to work with him a lot through that.
So why don't you tell us about your time at Greenlight? Everyone always hears about what it's like to work at a hedge fund, and, especially one as famous and as storied as Greenlight. Why don't you walk us through kind of how it was, what you experienced, and what you learned there?
Yeah, sure. So Greenlight, the work is spending a lot of time in the annual and quarterly reports and speaking to management teams, and then doing third-party research, expert network calls and stuff like that. And the idea is to try to figure out if we can develop an edge on something, and then invest accordingly. And generally over the Greenlight's history, they have had the most success with spinoffs and demutualizations and situations where management teams can have an incentive to understate the prospects of a business because of the way they get stock compensation. So that was something that really boosted Greenlight, from their inception through the mid to late 2000s. And then everybody started to catch on to that game, and it became a little less successful. But everything was good there. The first 6 or 9 months, I didn't really know what I was doing. And so I worked underneath and closely with a couple other guys that were senior. And then, after about 9 months to a year, you just start reporting directly to David and pitching your own ideas. For whatever reason, I was always attracted to short selling. So other than the biofuel thing on the long side, I mostly just did short selling. We shorted a company called Syneron, which was a medical device company that claimed they could get rid of cellulite. That one worked out. That was my first year at the company. That was my first idea, and it worked out really well. So that got that kind of helped me. It helped raise my profile, if you will, I guess. Because at the time, 05 and 06 were kind of hard periods to short because the market, I think, was going up a good amount. But yeah, for whatever reason, I had good luck on the short selling side at a time when it was hard. And, I wish I could say that performance was repeatable, but my luck since then's not been as good. But I guess my highest profile things, the Ceresna one was not that high profile, but we shorted a company called St. Joe, and that was a really fun one.
I know St. Joe. Okay.
Yeah.
Tell us about that. You were on the other side of the Fairholm guy, right?
Yeah, we are actually there, I guess, at the same time. But the story was, it's funny. It was a sell-side research person. I won't name the firm. I remember it, though. They called us up. They called up Greenlight, and they said, hey, we've got this great long idea. Who should take it? And then I ended up with the phone call. And the analyst, she was walking through the analysis of why this is like, the stock at the time was at $85. And she's walking through her analysis of why it's worth like 130 or 140. And like about 2/3 of the way through the call, I was like, oh my God, this is like a $10 stock. This is like the best short I've ever seen. So as soon as I got all excited, and as soon as I got off the phone, I go into David's office, and I'm like giddy as a schoolboy. I'm like, David, we've got to short this thing. You're gonna love it. Like this analyst thinks this land around this airport that every acre is worth $15,000, and there's 800,000 acres. And I looked on Google Maps, and like 90% of it's in a swamp. So it was just like real good. And then David was like, this sounds awesome, but you need to fly to Florida tomorrow and drive all the land and figure out exactly what's there. So I set up appointments with commercial and residential real estate brokers throughout the Panhandle, flew down there the next day, spent 3 days touring the whole thing, taking pictures, all this due diligence, meeting with all the brokers, getting the lay of the land. And it was just obvious that the land was worth nowhere near what people thought. So that worked out well. It went from like 85 to 15 or something over the next year and a half. We got helped by that kind of all happened concurrently over the next year and a half with the housing crisis. Right. That was
there was someone, I can't remember, was it Fairholm that was on the other side? Oh, there we go. You're a true market huddler guy. What are you drinking there?
So normally I live an hour north of New York City in the suburbs where we are. We get a lot of good beer. We just moved in with the in-laws in Cedar Lake, Indiana a week ago because my wife and I both work, and we have 3 kids, age 6, 5, and 2, which is about the worst age to be stuck at home because they're too young to be on a phone or do stuff with their friends, and they're just at maximum neediness. So we were kind of buckling, and we moved in with my wife's parents. And where we are, there's really no good beer. I generally like craft IPAs, but this one is a Revolution Brewing Anti-Hero IPA brewed in Chicago, and it's good. It's the best beer I have access to.
You sound like you know what you're talking about. You sound like a little bit of a beer expert, our kind of guy. Yeah. So listen, St. Joe, what is your kind of opinion about it now? Like, do you still follow it?
I haven't looked at it in a long time, but I think it probably hasn't moved at all. I mean, the story, there's never been much there. They own a lot of land in the Panhandle of Florida. There's not much you can do with that story.
Right. But is the land, it's like, I remember the kind of the negative side of it, and a lot of people say, no, it's swamp, you can't use it. And I remember Fairholm talking about, no, it's great, blah, blah, blah. And there was a big debate about whether it was swamp or not. What is the land? Is it usable? Was it just mispriced when it was $15,000 an acre, and now that it's gone from $85 the stock down to $17? Is it something that's worth looking at from a value side?
No, I don't think so. The issue is you can have very, very wide variances in land prices. They had some land that was next to the airport they were building, and that land would legitimately sell for, I don't remember the numbers, but let's call it $100,000 an acre. Right. And that's good. And then you have other land that can be turned into a subdivision or something. And, maybe that land is worth $10,000 or $20,000 per acre. Then you have land that's near a military waste disposal spot. They have a lot of land, believe it or not, near a bombing range where the Air Force practices bombing stuff. So obviously that land is really not worth anything, because who wants to live next to something where bombs are blowing up?
Right. It is Florida, though. That's pretty
true.
Common.
But the end result is something like, and I'm sure they've already sold or developed a lot of this, because this has been 13 or 12 years ago now. But the end result was maybe 1% of the land was worth more than 50,000 acres. Maybe 2 or 3% of the land was worth 10 to 20,000. And then the vast majority of the rest of it was worth less than $1,000. And a lot of it was worth $0 to $100 an acre.
Okay, I got it. Yeah.
Yeah. So that's the issue there.
So your love of short selling, why do you think you were attracted to that? What about short selling, what part of your personality says this is something I like to do?
I'm just naturally skeptical and ask a lot of questions. And I've kind of found that if you ask a lot of questions, you usually end up turning up bad stuff. Right.
Because I think Dan Loeb once said to Kyle Bass that there's no short sellers on the Forbes 500 list.
Yeah, that's certainly true. And it's a tough thing. And I really don't short sell much anymore at all. But my other fun short selling story was, and this is a kind of a random mix of coincidences, but I ended up with the Lehman Brothers short position. And by sheer coincidence, there were a few things in my background that made it particularly suited to us, or to myself, I guess. When we realized that the investment banks were in trouble with all the mortgages and commercial mortgage-backed securities they had on their balance sheet, we decided to look at every single investment bank, from Goldman Sachs down to Lehman and Bear Stearns. Bear Stearns failed, of course, got bought by JP Morgan. And then we were choosing, it was like, okay, who are the very worst ones? And turns out we thought Lehman was probably the worst. So as I started to do work on Lehman, it was around the same time they had done a couple risky transactions. They bought a company called SunCal, which was a land developer in Southern California in the Inland Empire. And they bought Archstone Smith, which was a multifamily real estate investment trust whose largest publicly traded comp was Avalon Bay, which I had coincidentally already been short. So I had an active short position on Avalon Bay at the same time Lehman Brothers bought Archstone Smith. So I was intimately familiar with that market. On SunCal, very funny story. They were an investment banking client of ours when I was at Citigroup back in 2003. We're going back almost 20 years now. And when they were our banking client, I flew out to Irvine, California, and I met the management team, and I did a couple of helicopter tours of all of their developments. So I was pretty familiar with how that, what their business was. Because if you read a headline in New York City, Lehman Brothers buys SunCal, you don't really know what that means. But if you live near there or you knew SunCal, you would know that that was like the riskiest of the riskiest possible thing you could imagine being exposed to at the top of the real estate bubble. Right. It's literally master planned communities that are in expansionary California suburbs, Inland Empire. But so we knew they had two major problems with those two things. And then David and I found, I think it was their first quarter 08 earnings report. Markets were starting to kind of fall apart, and everybody had losses in their equity books. And lo and behold, Lehman Brothers somehow makes money. So we schedule a call with the CFO at the time. I won't name her name, but everybody probably can look her up. And we're going through our list of questions with them. And 3 or 4 of the questions they were really unable to answer, or they avoided it. And yeah. It was clear to us that they were hiding things, or there was some deceit. And and they probably had some problems. And then David made me track down how they could have possibly had that equity gain. And I managed to find it. It was an investment they had in a power company located in the country of India called KSK Energy that their private equity group had invested in. And it was supposed to go public. It never actually went public, but it had filed the paperwork to go public. And when they filed the paperwork to go public, that division marked up the value at $1 billion. And that helped bridge the earnings hole that Lehman would have been in otherwise, to try to prevent their, ultimate collapse.
Right.
So, Chris, I remember this period well because I know David would get on CNBC and talk about the problems at Lehman, and there was all sorts of pushback, and he got labeled someone that was basically trying to do a bear raid and stuff like that. But it ended up being that he was right in spades, and that the Lehman guys were hiding it. There was also something about some sort of swap lines, wasn't there, that they did some sort of month-end kind of maneuvering every month to hide the losses?
That's a conspiracy theory that they say about almost every investment bank. And I'm sure there's some of that going on, but that, to my knowledge, has never really been proven to have been particularly nefarious.
Oh, okay. That was more often than not. They did that every month end, and it had nothing to do with hiding losses. It just had to do with making the balance sheet look as good as it could.
Yeah, there's stories that goes, and I'm sure it does go on, and I'm sure there's a lot of that going on. But that game, if you were to play it monthly or quarterly, at some point it would unravel anyway. So
right. So at the end of the day, though, what was Lehman had just gone out and bought too much real estate, and it was going to take them down because they had this private kind of marking on real estate that wasn't really indicative of the real value of it.
Yeah, if you had to summarize it, out of all the banks that were doing all the same stuff, Lehman Brothers was kind of hanging out they were traveling or traversing in the lowest grade, the riskiest stuff. And they did a lot of it because they were making a lot of money from it.
Right. So now, if we could kind of fast forward to today and these hedge funds that have been having troubles over the last, let's just say 5 years, in that the old model of buying kind of value stocks and shorting these kind of story stocks has stopped working. Why do you think that is? And you kind of alluded that you've been having some trouble on the short side as well. Is it a function of just the crazy amount of, speculation in the markets and it stopped working? And is it going to return? What are your thoughts?
So I've never liked any of the quote unquote value stocks, even when I was at Greenlight, which I think is one of the reasons why I never did much long investing, because quite frankly, a lot of the stuff that looked appealing when you're trying to buy stuff at a low multiple of earnings, there's usually a reason it's at a low multiple of earnings, and it's because it's a garbage company or the cash flow doesn't match the earnings. So to me, the label value is misleading. Value to me is buying something for, cheaper than it's going to be in 5 or 10 years time. That's value, right? So anything can be value. Amazon at 20 times revenue 7 years ago was value because they'd grown like a weed every year since.
Right.
But people apply value to these low multiple stocks, and they say, well, if it's trading at 6 times or 8 times or 10 times or 12 times earnings, then it's value. But, look at a company like General Motors, which, I've talked to Greenlight about in the past, and we've disagreed on it. And it quote unquote trades at 6 times earnings, but this all pre-crisis, of course. I don't even know what's going on with it right now, but it was trading at 6 times earnings for 5 years in a row. Now, mathematically, that's impossible, right? You can't trade at 6 times earnings at the same stock price 5 years in a row unless your earnings are not real, because earnings means cash. And so if you are accumulating cash every year, then your PE multiple will be going down by the earnings amount each year. So if you're actually earning, let's say we'll use round numbers. Let's say they're earning $5 and the stock's at 30. Right. If they're actually earning $5 a year, then on a net, after you net out the cash, in year 2, they're 25. In year 3, they're 20. In year 4, they're 15. So after 4 years of trading at 5 times quote or earning $5 a share, you're now trading at 3 times earnings. Now, if you're not trading at 3 times earnings, you got to start to ask yourself what's going on. And that's, of course, when you look at the cash flow statement, and you can see that General Motors is spending a ton on capital expenditures, and the free cash flow is basically zero. And it's way less than stated net earnings. So that's not a value stock. You got to look at it on the actual economics of the business. And on the economics of the business, it was trading at like a high teens multiple, which is a little bit less attractive. And they also have, longer term structural issues. But
and then
so
what about on
the value side?
Right.
Yeah.
And then what about on the short side? Because, it used to be that hedge funds used to make their living going off and shorting names like, the Teslas and stuff of the world. That, Einhorn even wrote a book about Allied Properties. Was there Allied? What was it?
Allied Capital.
Allied Capital. And these were the kind of names. And you guys, obviously with Lehman and St. Joe's, you did all sorts of these things. But those have not been successful in a long time. Why do you think that is?
There's two different things going on, and the first one affects the longs and the shorts, and that would be the market's getting more efficient. And when I started at Greenlight back in, this is late 04, early 05, we were one of the few firms that were reading 10Qs, 10Ks, and back then you could actually get on a conference call and ask management questions. Now it's just sell side that's allowed on. But, back in 2005, if you read a 10Q or a 10K and you read the footnotes and stuff, you had a material advantage. It was that easy. Today, everybody and their brother reads the 10Qs and the 10Ks, and everybody listens to conference calls. So the markets are just way more efficient. And, in the old days at Greenlight, we made a lot of money on the short side finding accounting frauds and looking for accounting problems in the footnotes and things of that nature. Nowadays, people are all over that. People see this stuff, and also the gap in the FASB standards have gotten better. So the accounting is actually, the reporting is higher quality today than it was 15 years ago. But that affects the longs and the shorts, and it makes it a harder game. Whether you're looking for something good to buy that you think is mispriced because maybe the net income understates the economics of the business, or the opposite on the short side. The other thing that's different, which I think a lot of people are finally starting to appreciate, is between 1995 and 2010, with all of these tech stocks, there was this promise of a lot of growth from these companies, but they never generated any cash flow. And they may have even been actually delivering on the top line, but there was never any bottom line. So when you had a recession or some impact economic shock, whether it was 9/11 or the 07, 08, 09 stuff, the legs could get taken out of these things and they could completely crater because the investors have to ask themselves, are these things ever going to make money? But now in the last, 5 to 10 years, you can see like Google and Facebook make a lot of effing money. Like Facebook last year was running at a 50% operating margin. They're at 40 now, but they make a lot of money. So there's now a path. People now believe in a path and the path is, look, if you can grow 30% or so a year for a decade and you're kind of eating and cannibalizing up, or not cannibalizing, but eating your industry, even if you don't make money for 5 or 10 years, you'll be in the position of such dominance in the future that we're willing to bet on you based on the revenue. Because if you're growing revenue 30% a year consistently, obviously customers like you, and obviously you're killing the other people in your competitive space. And so that it's just taken investors a long time on the short side, especially, to recognize and appreciate that fact. And it is an indisputable fact. I mean, it really is. If you are able to take a huge chunk of market share in your little sector or wherever you're competing, like you will probably be profitable at some point.
Do you think do you think that's a problem for society? Like, let's just take it to its extreme. Amazon is chewing everyone up and is getting all sorts of smaller retailers are going the way of the dodo bird. And then eventually they're going to be such a dominant player that they're going to be able to charge whatever they want. Do you think that it's something that the government should be looking at and trying to actually slow down?
So it's a really complicated question, and the answer is yes. The problem is, how do you implement? So one of the biggest problem in the last 40 years and why we have the social divide is companies are made up of people, and they're funded with money, of course, capital. So you got capital and labor, right? So capital is the profits and the funding of the business, and labor are the people that make it work. And you may as well just throw management into the capital camp because they all make a lot of money. So in the 70s, labor had a lot of strength, and we had a lot of unions in the country. It was hard to be capital, and labor's share of economic profits were near an all-time high. And as a result of labor taking so much and being so aggressive, and the unions were really aggressive back then, society they fell out of favor. And in the late 70s, early 80s, and Reagan, and then every university starts doing studies on capitalism and competition, and we really don't want labor unions. So unions quickly went out of favor over the next decade, and everybody loved capitalism, and everybody believed in this idea of competition and free markets. And you fast forward to today, and over the last 10 to 15 years, even 20 years, the Federal Trade Commission has let almost every industry consolidate massively. So now, let's look at food processors, right? So we're on my website on Hedge, we follow a lot of these food plant shutdowns, and the food processors there's really only two or three now. There's only Tyson and Smithfield Foods, and maybe one or two others. In the fertilizer space, there used to be three big players that had each of the three segments between ammonia, potash, and phosphate. You had CF Industries, and they had a little bit of each of those three products. You had Mosaic, and you had Potash Corp, which is now Nutrien. In the last 8 years, they've all shuffled assets around, and now they're each pure play dominant players in their respective silos. So now only one company makes potash, only one company makes phosphate, only one company makes ammonia. So they're all oligopolies. Same thing in healthcare. There's really only four major healthcare insurance companies. You look across the board. This consolidation has created a huge wedge between capital and labor. So now you, of course, see the social ramifications of that. Everybody's pissed off at stock buybacks, at how much management teams make compared to the average worker. This is a pendulum that swings over very long periods of time. And we're probably back into a rebalancing phase over the next 10 to 15 years. That's why you get a guy like Bernie Sanders, who 10 years ago would have never even been considered, came very, very close to getting, a major nomination from the Democratic Party. So on to the Amazon thing and why that's a little bit different. Amazon is able to deliver massive cost savings to the consumer via low prices as a function of technology and scale. And the technology component is the data aggregation and the analytics that allow them to basically choose. So Walmart is actually a little bit similar, but with a lot of monopolies or oligopolies, if they have physical presence or something, you can kind of break them up, and you can say, okay, whatever it is, airlines would be an example. That's another industry that's super consolidated now, airlines. Look at United bought Continental, Delta bought Northwest, American bought US Airways. I mean, we went from 8 to 12 airlines 15 years ago to really only four major ones. We got United, Southwest, Continental, and American. Then you kind of got Spirit and JetBlue lingering around. But, other than that, it's super consolidated. But with airlines, you could actually break those up, and you could say, all right, Delta, you've got to become two or three companies. American, you got to become two or three companies. And they would just split up the airplanes. They'd split up the employees. They'd split up the routes, and you'd get good competition. And it really wouldn't impact that greatly the ability for the airplanes to do what they do. So you can break up an industry like the airlines. Now, how do you break up Amazon? Because Amazon is one of these businesses, which a lot of internet businesses are, including Facebook, including any social type business, where the value that it's able to drive is a direct result of the number of users that are on the platform. So it's more complicated, because what would you do? How would you break up Amazon? Because if you said break it up into 10 different companies, what does that mean? Do you 10 different companies that sell electronics, or do you want them to break up by vertical silo? And then if you break them up by vertical silo, you're not really creating competition within those silos. And maybe they lose some economies of scale. I don't know. It's trickier. I don't have a good answer, but it's something that should be explored, because at the rate we're going, Amazon is going to eat everybody's lunch, and there's nothing anybody can do about it. I was joking with my father-in-law 3 or 4 weeks ago when he said, well, how come my local nursery's closed, but Home Depot's open? And how come the restaurant's closed, but McDonald's open? And how come the department store is closed, but Amazon's open? And I was like, 5 years from now, we're all going to be working for McDonald's or Amazon. That's just the way it is.
Now, do you see, you mentioned you saw this trend might be changing. What do you think are the investment ramifications if you're correct that trend is changing?
When I say the trend is changing, it starts socially, right? So economically and how you would implement it will take a long time, but you could start with the health insurers and the idea of Medicare for all. But if you look at corporate profits as a share of GDP, that would be what you'd look at as your pendulum. So corporate profits as a share of GDP are at record high. Then you say, okay, were they at the 1970s? They were like 40 or 50% lower. I don't have the data in front of me, but something like that. So if you said, okay, corporate profits are going to be 40% lower 15 years from now, if the next president in 2024 is kind of like a Bernie Sanders, then we should expect corporate profits will be 40% lower than they otherwise would be. Well, if that's the case, then obviously the market's not going to go up. You're going to have corporate profits down 40%. Now, offsetting that is some of these issues with our Amazon problem is those guys are becoming a bigger part of the market. They're becoming a bigger part of the economy. How do you deal with them? Because there's a lot of complicated things that it's impossible to speculate on until you see who's actually going to put the plan forward and try to implement it. So yeah, it's tough, but to look at the market now where it's near an all-time high, when we're on the cusp of the probability of a social change, a change of the social order is increasing. Unless you're trading or you only have a 1 or 3 year view. But if you're 25 or 30 and you've got like a 30-year view, it's very hard. You don't want to extrapolate the earnings growth of the last 30 years forward another 30 years, because it's just very unlikely to continue that way. It really can't continue that way, because two things benefited earnings over the last 30 years, which can't be repeated. One, you've had capital extract as much as they can out of labor to the extent that labor is now furious. And two, you took interest rates from 10 or 12% down to close to zero. Those two things have hugely benefited corporate earnings. And if you think 30 years from now, corporate profits are going to be twice as high as they are today as a share of GDP, and interest rates are going to be negative 10%, which who knows, maybe they will. I have no idea what the hell they're going to do with interest rates. But that's a pretty big leap in my mind.
That's a great way of putting it. That's outstanding. So listen, you mentioned that you're no longer at Greenlight, and I think why don't you tell us a little bit about you're quitting there and where you've ended up since then.
This is a podcast episode part 2, but so I was kind of over with Greenlight at the end of 2008. I tried to leave, and we agreed that I'd stay another year. During that second year in 2009, I didn't really, halfway through the year, 2/3 of the way through the year or something, I realized I wasn't really going to stay. So actually I bought a little sailboat. Sailboats are nice because you can buy them with a 20-year mortgage, and it counts as a second home. So you get tax deductibility on the interest.
Nice. Come on.
So,
really?
Yeah.
You guys get to do that?
Yeah. So I was able to buy a sailboat, and my monthly payment was like $400 a month or something. And
awesome.
I bought it, I was single at the time, and I bought it to, increase my attractiveness to the
cachet.
Yeah, exactly. And but the plan was when I left Greenlight that I would have a captain sail the boat down to the Bahamas, and then I would go down there and live on it for 2 or 3 months, screw around. I'd never sailed before. I had no sailing experience, but because of the economics of buying a sailboat with a mortgage, and the fact you don't have to buy gas or anything, it sounded pretty good. I did that, and that was awesome. And the plan was,
did you teach yourself to sail, like, or did you take a course or something? Like, it's not. You grew up in the middle, like in farm country, didn't you?
Yeah. So it's a long story. when I'm in the Bahamas, this is 2010. Well, actually, the captain actually sailed it down to Florida. He sailed it down to Daytona Beach because I had a bachelor party and we went to the Daytona 500. And then 3 of my buddies and myself sailed the boat from Daytona Beach to the Bahamas. We didn't sail it, though. We just motored the whole way. It was only like, I don't know, 90 miles. We left at like 6 p.m. at night, and we got there the next day at 10 in the morning.
Okay.
Pretty easy. And then I screwed around in the Bahamas. When I was there, I was just motoring around all the time. And my thinking initially was I'll go back to New York in the summer of 2010 and either start my own hedge fund or get a job somewhere. But what ended up happening was I was having a lot of fun. I liked it, screwing around down there. And I had a buddy that came down who had just lost his job, and he was kind of living on the sailboat with me. And then he brought a girlfriend down, and then there's 3 of us, and it was getting early into the summer, but close to hurricane season in June. And we decided, we were drunk. We were like, fuck it. Let's just sail the boat up to New York from here. And so we did. And I'd never really sailed before. And it's on paper, you would guess it was a 7 to 9 day trip. And we did it. We ended up with like perfect weather. We never had any problems. We were like drunk the whole time, 24/7. It was the easiest sail ever. I remember we were drunk when we finally got to land in like Maryland or somewhere. We pulled the boat up to a waterside bar, docked there. I think I got so drunk I had to leave the restaurant and fell asleep in the boat.
A true huddler. This is a true huddler.
Yeah. So because of the easiness of that experience, I was kind of cocky, and I thought to myself, I'll just sail it back down to the Bahamas in the fall. And in October, I was planning of 2010. I was like, I'm going to move it back down there. If you don't take your boat somewhere warm in the winter, you've got to haul it out. Right. So that things don't freeze, and that costs a lot of money. And I didn't want to spend the money to have that done. So I was like, all right, it was easy to sail the boat up here. I'll wait till the end of hurricane season and I'll sail the boat down. I just need a couple people to go with me, because when you're sailing in the open ocean, someone's got to be awake all the time. So you figure with 2 other guys, you get 4 hours on, 8 hours off, 4 hours on, 8 hours off. So I asked all my buddies, and nobody could really come except one guy. A buddy of mine from Texas said he would come. So I needed a third person. So I put an ad out on Craigslist, and I found a homeless guy from Maine.
You did it. Honest to God, you took a homeless Maine guy.
Yeah. He was an old salt, like a 75-year-old guy with long hair that never showered. And he showed up at the dock the day we were leaving. I'd never met him before. We emailed or something. He had apparently been living in the woods in Maine or something. And I didn't really want to pay anybody, so he was free. But his condition was I had to fly him to Florida from the Bahamas. And I was like, fine, those flights are only like $100. So we have this crazy homeless guy from Maine and my buddy Alberto. And we set out, and we're going. And we get into trouble the very first night. We had like whiskey and stuff before, as we're leaving New York Harbor, going to the Verrazano Bridge. I have the first sleep shift, and then I'm supposed to take over, I think, at 4 a.m. And at like 3 a.m, Alberto comes down, and he says, "Hey, dude, I don't know if this homeless guy knows what he's doing." I was like, what do you mean? And he goes, "The boat's currently headed to England." And I was like, what are you talking about? So I come up on deck, and I look at the radar charts, or the map, the charts. And sure enough, he's got us like almost south of Montauk. We've been sailing east, and we need to sail south. And I was like, Wally, what are you doing, buddy? And he's like, well, I just thought with the winds and the way that it is, it'd be faster to go this way first. And I was like, dude, the winds are fine. Go south. We're trying to go to the fucking Bahamas. So we got that straightened out. Anyway, so we're moving along. First couple of days are uneventful. I rented a satellite phone from some company. So we had a satellite phone to call in and let people know where we were and all that good stuff. And on day 3 or 4, the weather started to get bad. The sea started to get rough. And turns out there was a hurricane south of us, Hurricane Sharon. So I was like, okay, that's bad. We didn't really have any good options. We were too far from Bermuda. We were kind of off the coast of North Carolina, 300 miles out to sea. You don't really want to go in that way. That's very treacherous waters. That's where all the pirate shipwrecks happened in the 1700s because there's a lot of shoals.
Yeah, it's the Outer Banks.
Exactly. And we called the Coast Guard and we told them our position. And they said, look, you guys are kind of screwed. You're out of helicopter range. You guys just gotta hold down the fort and don't do anything stupid. So we got pretty beat up. I think the badness happened. It lasted 2 or 3 days in a row. We lost 2 or 3 sails. The boat sprung a leak. We lost our fresh water pump. So we had to take apart the water tanks. It was a disaster.
How big was your boat?
46 feet.
Oh, it's pretty big. Okay. It wasn't like it was a little boat. Yeah. Okay. Yeah.
Yeah.
You had a 46-foot boat for $400 a month?
That's pretty sick.
Yeah, it was around that price. Yeah, it was very reasonable. I bought that boat. In the peak of the crisis, and the dealer was stuck. So the way that it was a Beneteau, which is the Beneteaus are like the Chevys of sailboats. They're mass manufactured, and it's like what everybody has. I guess today would be the Honda or the Toyota of boats, but so the dealer, the way that Beneteau distributes their product, and it's a French company, is the dealer has to actually buy the boat first and then they resell it. So there were a lot of dealers that had bought boats that they couldn't move because the great financial crisis hit.
Yeah.
Right. And so they were willing to get out of there. They would sell the boats for less than they bought them from the manufacturer.
Okay.
Great time to be a buyer.
Right.
So anyway,
you hit this bad weather and all this stuff. And so did you guys make it? Obviously you made it. You didn't lose Wally.
We didn't lose Wally. We probably thought of throwing him overboard a few times, but he couldn't. The guy couldn't navigate his way out of a paper bag, but he actually did know how to sail. So he did teach me some stuff about sailing. But when we finally did get to the Bahamas, we were basically out of fuel. The boat's leaking. We don't have fresh water. We've lost almost all of our sails. We had duct tape all over one of our sails to hold it together. And when we pulled in, I called the dock master at the marina we were going to go to. It's called Mangoes in Marsh Harbor, which got destroyed from the hurricane last summer, unfortunately. But I called the dock master, and he said, oh, okay, you can try to come in, but the tide's kind of low. You might get stuck. And I was like, oh, we're going to try it. We're desperate. We've been at sea for 11 days. We were only budgeting 7 days. We're basically out of food, out of booze, out of water. So the slip is like 60 feet in front of us. It's so close. We're like right there. And I'm motoring over to it, and boom, we hit the bottom, and I grounded the boat because it was low tide. So now we've got to sit there while everybody on shore is like pointing at me laughing for being an idiot for getting stuck. And we got to sit there for 4 hours to wait for the tide to rise. So anyway, the tide finally rises. We get into our slip, and the dockmaster comes out, and he's like, where are you guys from? And I was like, we're United States citizens. He goes, this boat looks like it's a Haitian refugee boat. We were so beat up, and the boat was in such bad shape, and we had duct tape all over the place and all this crap.
That's awesome.
So anyhow, what happened after that is the boat was so beat up, obviously, that I couldn't leave it there. It would sink if I would have left it there. So Alberto went home. I got the homeless guy over to Florida, and I decided I would stay there and repair the boat for the next month, the month of November. And while I'm doing that, there's this kid walking up and down the dock every day looking like he's in trouble. And I didn't know what his deal was, but we'd actually busted a very large, heavy duty piece of equipment on the forestay of the sailboat that holds the jib in place, the front sail. And that's a 2 or 3 person job. So I needed help taking that apart. And I asked that kid if he'd help me, and we got to know each other. And he had actually paid some guy. He was Australian. He was like 21 or 22 years old. He paid somebody like $5,000 to go use his boat. And then he got there and there was no boat and there was no guy. He just got swindled. So he was in a bad spot. So I let him live with me on my boat. And in return, he wanted me to sail him to the Dominican Republic.
Okay.
So I said, okay, you help me fix the boat for the next month and I'll sail you to the Dominican Republic. I left out a part in the middle. In April of 2010, I met my now wife. A good buddy of mine had come down to stay with me for 2 weeks. And when he came down, he was with me. And then he called his cousin and he said, hey, my cousin's living alone in Arkansas. Do you care if they visit? And I was like, no, what's his name? And he goes, it's a she. And no, you're not allowed to touch her. And I said, oh, of course I won't.
That didn't work out.
Yeah. So she was actually a kind of a senior salesperson to Walmart. So she was living in Bentonville, Arkansas, or Fayetteville, I guess, living alone. She came down, visited. Now we're married. So you kind of guess what happened there. Funny story, actually. Well, I'll save that for another time, but we ended up hitting it off, if you will. So my now wife came down to the Bahamas with me after we had the boat fixed. So me, her, and the Australian set off to the Dominican Republic, which was like a 5-day sail, I think. And the Australian, the reason he wanted a sailboat in the Bahamas is because he used to be a professional racer on the Sydney Hobart race circuit, which is an Australian sailboat race, which is one of the most famous in the world. So he was kind of the real deal. He really knew what he was doing. And on those 5 days, he taught me basically everything that I needed to know on how to use the sails in the boat. Because otherwise I really didn't know. I learned a little bit with the homeless guy. And anyway, that was like my real learning experience. Ironically, it was like 1.5 years after I'd had the stupid boat.
Much like trading and investing.
Yeah. So anyhow, I'll wrap this up so we can move on to other things. But after the Dominican Republic, we went to Puerto Rico and we met this couple at a bar. We were drunk. They just finished a 6-year circumnavigation and they convinced me and my wife to sail around the world. So we ended up sailing down to Trinidad and then we sailed along the north coast of South America. Then we went through the Panama Canal, through the South Pacific. We went to all the islands in the South Pacific, French Polynesia, Tahiti, Bora Bora, the Marquesas. We went to Samoa's, Cook Islands, Tonga, Fiji, Vanuatu, all that great stuff. And when it got to New Zealand, we learned my wife was pregnant. So we ended up sailing to Australia and selling the boat in Australia and coming home and having kids.
Wow. No. That is a terrific story. That is honestly,
that is pretty awesome.
That is an awesome story.
That's awesome.
I really enjoyed that. Okay, so why don't you tell us, you come home, you have some kids, and now where does the career go? What are you doing today?
Sure. So I started out, I tried to start a little hedge fund, and I raised some money, managed a little portfolio. The idea was, long, short, concentrated. It did fine. The cumulative results were pretty good. We had volatility, though. I was short some energy stuff in 15 or 16 that blew up in my face, and I had very high volatility the first year to the positive. Then I had high volatility the negative the second year. Then I had kind of a muted third year. And then we had a really big final year. So the cumulative returns were very good, but the volatility precluded, any chance of raising any real money. And I was also quickly realizing that I just didn't really see a future for asset management like it had been. The world entering asset management in the mid-90s was just a lot different than entering asset management now. And it really wasn't fun for me. So I wanted to take my kind of 2 decades or 15 plus years of financial experience and research and combine that with, I've always been a tech geek. Remember I wanted to do computer science. I'd done virtual mall, Untitled.com. I built all my own computers, and I used to build and sell computers in high school and college. I did some coding and stuff at Greenlight to aggregate data. So I was like, the asset management industry has a lot of headwinds facing it. Why don't I get into a position where I can have some tailwinds? So I started building this platform called Unhedged, and the website's unhedged.com. And the idea is to automate the functions of a research analyst and to put all of the data that anybody could need to conduct research kind of at your fingertips on one platform. Because almost all of the data that you use in a research process is the same, whether you're an analyst or any research process that deals with business, finance, and economics. You're always dealing with the same data. You're either dealing with market data, or you're dealing with earnings call transcripts, SEC filings, press releases, news, economic data from either the BEA, the BLS, the USDA, the EIA, census.gov, or you're dealing with data from state or local governments. It's all publicly, freely available. So there's really no data that an equity analyst looks at, a research equity analyst. I'm not talking about like quant traders that buy credit card data or like real-time signaling stuff, but people that are taking longer term views to do research. It's the same data everybody looks at. And you've got thousands of people doing the exact same thing. I mean, how many people should really be building their own Netflix model? Or how many people need to type in the data for any of these models that everybody does, or any research process? And I was reading an article last summer in the New York Times, a great long form, deep researched article on Uber and their impact on traffic and ride sharing and taxis around LAX airport. And I was done reading it, and I was like, wow, like every research analyst is going to want to read this and recreate the work. If you're a lobbyist on behalf of the taxi industry or the ride sharing industry, like you're going to recreate this work. If you're a lawyer involved in this, you're going to recreate this work. Consultant, accountant, if you're a reporter and you want to like do a follow-up story, all of the work that person did is like trapped in that guy's head or in his notes. And you're going to end up with thousands of people recreating the same 100 hours of work or however many it was. And it's a waste of like 100,000 hours of human capital. So what if you had a platform where all the information's in one place? So you've got like a data layer, and then on top of the data layer, you build some productivity tools to allow for collaboration, sharing, organizing. And then you can, from that create some output where the output can link back and source to the primary source data and the underlying data, so that everything is immediately verifiable and you never have to second guess whether something's accurate or not. So on our platform, everything we do, we require basically that it sources directly back to the primary source document. So if we mention something from a press release or an earnings call transcript or an SEC filing, and you look at it, it's going to take you right to that spot in that document. And you know for a fact that it's accurate because the data is right there in the primary source. Just a little bit ago, I tweeted out a table on the Federal Reserve's balance sheet, which they update every Thursday from the H4.1 release. Now, if you saw this balance sheet in a Wall Street Journal article, it would be a static image and you would only get what they show you. And if you had like second guesses, you would have to go to the Federal Reserve's website and make sure the numbers were right, because probably some human had to type it in. Now, on our website, we actually ingest that data through the federal government's API. And so it's 100% right 100% of the time because no human gets involved with it. And then it's completely immersive and exploratory. So if you wanted to see what was the Federal Reserve's balance sheet in 2003 or 2009 or 2012, you can just explore that whole data set on our site. It's interactive and it's just a much higher quality user experience. And it unleashes a lot of productivity when you can do it that way. And then on the collaborative front, we've got these research pods where users can come together and share information in like a project folder, if you will. And there's a chat room you can message, and it's just a way to eliminate a lot of redundancy that currently exists in professional research.
Right.
So you're taking your job that you did at the hedge fund and saying to the world that no sense of us all doing this. I'm going to make a website that we can all get together and use the same data, in essence.
Yeah, trying to automate the research analyst. And we're also trying to prove to the world, or in general, the financial industry if you look at the data in a Bloomberg or a FactSet or a Thomson Reuters, and you look at the research that the sell side creates, a lot of that information is actually interesting to other people. Like maybe you're a manager at a restaurant and you'd like to know how same-store sales have been doing at McDonald's and Wendy's and Burger King, or maybe you want to know how much of their revenue they spend on food and labor. There's not like any easy way for them to get access to that right now. And there's a massive wealth of information and data that's trapped in the finance vertical, and it's trapped there because of the high price point. So the financial data products are all $20,000 to $30,000 a year, and sell-side research is similarly priced when you factor in the count of the soft dollars and the relationships required to access it. Our premise is, what if you just charged $30 a month or $20 a month or whatever the number is, like a consumer price point? What's the market look like? Because we know if you're charging 20 or 30 grand a month or a year, the market is only 50,000 people. There's only so many asset managers out there, and those are the only people that will actually buy this stuff that have the budget. So if you're going to charge, 30 grand a year, Capital IQ only has like 35,000 subscribers. FactSet has like 50,000 in North America. Bloomberg has 100,000 in North America, 300,000 globally. But your total addressable market's very small because you've got this high price point. Well, what if you charged a consumer price point? What would the market look like then? Then it might look like a Wall Street Journal readership base or a Fortune magazine or a Barron's, or if you go industry by industry, there's trade publications in every industry, like the restaurant industry. You've got Restaurant Business Magazine. They have 400 or 500,000 users, and those are all restaurant managers. If you could offer to those people for something less than $400 or $500 a year, and said, hey, we're going to provide you all the data that's publicly available on what Wendy's and McDonald's and Taco Bell and Burger King and Pizza Hut and Domino's Pizza, Papa John's, how all those businesses are trending, how many units they have, how much, whether the units are shrinking or declining or growing, what the sales per restaurant are, the same store sales, margins, blah, 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 food costs as a percent of revenue, labor costs as a percent of revenue, rents as a percent of revenue, on and on and on. There's a lot of interesting information out there that is, there's the market for it would be much larger if you could just make it accessible. And now with technology, we can make that information accessible at a consumer price point.
Nice.
I'm looking at it right now. It's fascinating. There's so much here. I'm like, as you said, Wendy's, I typed it up and pulled up all the income statements and everything like that. And I'm looking at all this and I'm wondering, are you programming this, Chris? Are you actually still doing some coding? Did you learn JavaScript?
I did learn JavaScript, but I'm no longer coding it. It's funny. Our CTO told me to just stop coding because I was wasting his time because my coding's so sloppy.
It's like when you tell the boss to stop trading, like get off the trading desk. You're just making a mess here.
Yeah, exactly. No, we're basically headquartered out of a town in the middle of Kansas, the state of Kansas, and it was kind of a unique opportunity. Kansas in the 1980s, they had centralized their hospital network infrastructure because back in the 1980s, computer networks were always centralized. So there were a lot of IT people in that town in the middle of Kansas. And over the last 5 years, with the advent of the cloud and all that, Kansas has been moving jobs to Kansas City. So there's a lot of stranded IT people in this town. And I found a team of people there, and we've been together now over a year all in. And they're great. There's 6 guys out there that do all the coding, and they've all worked together for over a decade. And they're all very experienced. They all have a background in healthcare, which is great because, we're very sensitive about data security and data retention and those things that are important in finance. In the tier of data security, it's probably number 1 is healthcare and number 2 is finance, or maybe even finance is higher than healthcare. But those are the 2 most critical sectors when it comes to those things. So,
right.
No, it's a solid team of guys.
Well, that's terrific. Right. So why don't you tell people where they can find it, how they sign up, how it's going to work, and then also tell people where they might follow you and learn more about yourself.
Sure. Anybody can sign up at unhedged.com. You can sign in with Twitter, Facebook, Google. You can create an account just with your email address and a password. We tried to make it as frictionless and simple as possible to sign up. You can find me on Twitter. My handle is Quisitive Invest. The name is Inquisitive Investor. Yeah, that's me.
Well, that's terrific. So for people that are trying to get the Twitter handle, it's QUISITIV as in Victor E, and then invest, INVEST, and it's all one word. Chris, it was a pleasure having you on. I think I've never laughed so hard about your sailing story. That was just terrific. It's we're gonna have. It sounds like there was more stories that we're still there to tell. So we'll have to have you on again sometime. Thanks very much for coming.
Thank you. Great to be on.
Okay, Lena, hop on.
Hello.
So everyone's drinking. We have the smorgasbord going again, right?
Yeah. We should next week get back to. If we got to find a way to get the sponsor beers out distributed to us, so we can actually get back to some sponsor beers.
It's very bad.
I'm about to start making moonshine. That's what I am.
That's Lena. That's her idea. So we better get to it. We got a long show here. So let's. What's everyone drinking? Let's start with Lena. Ladies first.
I'm drinking Tag You're It Wildly Delicious IPA by Big Spruce Brewing. This is my last beer in the fridge.
Oh,
it sounds nice.
Yeah.
How about you, Patrick?
That's the ones your daughter brought back from her trip, right? Anyway,
I think it might be.
Yeah, I'm drinking the from Great Lakes Brewery, the Pompous Ass English Ale.
Nice. Kind of like that name. And actually, I'm drinking another beer. It's not even a beer. I went to check out what there was in the fridge, and I'm having to take one of my university daughter's, her cider. No boats on Sunday cider.
All right. Well,
I don't know about it. Like,
I have nothing to say about it.
All right. All right, Kev, give me some legal stuff.
Okay, let's do our legal stuff. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include paralyzing, pulsating crude cramps, hostile humming bear amnesia, and or frozen foot-fed fungus.
Ooh, that sounds nasty.
Yeah.
I would never want to
the
get
pulsating
Words that
crude
should not be
cramps. I
put
thought that was a
together.
good one. I went for a little alliteration this time.
All right. All right, time to move on. All right, joining us now for his monthly segment is Kuppy for the Kuppy's Corner. Now, I have to ask you, Kuppy, that's quite the beard you have there. Is this a permanent thing, or how long is this beard going to stay on the face?
This is a Corona thing. I decided I wasn't going to shave till they let me out of prison here in my condo.
I liked it, Kuppy. It's Kev here. I liked it when you said you look like a fat Jim Morrison.
Like the later years, right before he drowned.
Right. Yeah, exactly. And I said I told you, I said, just make sure you don't drink like Jim Morrison.
It might be too late for that. I don't know what it is about coronavirus, but it makes me sit at home drinking too much and reading 10Ks.
Oh, well, you got the playoff beard going.
Yeah.
I hope they let me out soon. I got to shave this thing.
So, Kuppy, let's just very quickly just touch on shipping, and then we'll move on. Right? The one question a lot of people keep asking is simply, why haven't the shipping stocks taken off yet? And so, what's your take on all of that?
Sure. I mean, I'm the tanker guy. I guess, do my part. Look, I don't really know why they haven't lifted. I think it's partly that the world's just gotten stupid lately. I mean, you had this COVID thing circling Asia, and the stock market was sort of benign. And then one day stuff mattered. And I think it's the same with tankers. One day people will actually notice this. I think what's holding people back right now, and when you talk to friends of mine that have no exposure, or they're small exposure, they always say, Kuppy, this is going to last a couple weeks and it's done. And I keep saying, how is it possibly done in a couple weeks? We're going to keep building up inventory for months and months, because when they jailbreak us all, I don't think a lot of people are going to go out there and spend a lot. I mean, 25 million people don't have any jobs. I don't think people are getting on jet planes anytime soon. It's going to take a long time to get back to normal. And you're going to have this surplus of crude oil looking for a home. And I really do think this is one of those once in a lifetime, this might be the greatest opportunity I'll get in my career to see something, bet it big, and, cash in some 10-baggers in 2 years, or maybe 20-baggers. I don't know. I've been thinking this through. You have price to cash flow, you have price to earnings, but none of these really apply anymore to these tankers because the earnings are just so off the charts. And, when you say this thing trades at 0.27 times cash flow, like, what does that even mean? Like, it's always supposed to be, multiple, 5, 6, 10. So instead of using price to cash flow, what we're using is a new metric called DATAM, which is days to earn the market cap. So, take Scorpio, because I just did the calculation a few hours ago. It's somewhere in the 80 to 90 datum range, which is, it's kind of, it's a little better than some of the other guys because they have a little more financial leverage. Someone like Euronav is, in the hundreds. But this is how I'm going to be valuing these stocks from now on, based purely on datum. And as charter rates keep going higher, because, people think, oh, Kuppy, the thing's already over. It's already peaked out. And I think that's the bear thesis. It's going to peak out next week. Oh, maybe it's next week. But as the rates keep going higher, the datum keeps getting lower because the charter rates keep going up and the cash flow keeps going up. So I don't know. I just think people are eventually going to realize that, one, this is going to go on a lot longer than most people think. And when people start realizing this isn't a week or two, this is going to be something that probably goes on for a few years. I think you're going to see all the short interest, which is in some of these companies up to 10% in the last 2 weeks. I mean, the shorts have just been laying into it. I think you're going to see the shorts panic cover. And I think you're going to see these stocks go screaming. I mean, a good shipping cycle, these things should all go up 10 or 20 times. And, I think this is the greatest shipping cycle, we're going to see in our lifetime. So I don't know why they haven't responded yet. There's always the question if, I'm so right and CNBC has Kramer talking about it, it's late to the party, but I don't see it that way because the stocks haven't moved yet. And, as I said, they're at like 90 datum.
Yeah.
Right.
So, Kuppy, one of the things that, sorry, Patrick, I'm just going to jump in here. One of the things that you saw was like uranium. That thing sat there forever and ever and ever, and it didn't matter until all of a sudden there was kind of a catalyst, which was, some mines coming off, and next thing you know, they're all screaming like they're on fire. Do you see any catalysts that might be on the horizon for shipping stocks?
I mean, the catalyst is clearly that we're going to build up a 2 or 3 billion barrel glut, and that charter rates will go to all-time highs. And, that's already happened. That's been happening really for the last 2 months now. Maybe it's Q1 earnings, maybe it's Q2 earnings, maybe it's dividends and special dividends, maybe it's tender offers, Dutch offers, and buybacks. I mean, most of these companies trade at less than half of net asset value, and some of them are at a third of net asset value. So, you could do a Dutch offer at twice today's quote, and it's still going to be value creative. So
right. Maybe it's a takeover. Maybe it's a takeover. Maybe it's earnings.
Yeah, the earnings are coming out.
So here's a funny thing. Friends call me up and they're like, Kuppy, if you're so right, why are these things not going? And I think that's what's keeping people out of the stocks. As soon as these things hit 52-week highs, I think they're going to scream like you've never seen something scream before, especially with all the short interests. And, there's been a couple short sellers poking around, with these crazy theses. Oh, these guys are making so much money, they're not going to get paid. I saw some articles written about that. Just think how crazy that is. These guys making so much money that the guys who chartered the vessels out can't afford to pay the bill. Like that's like a fake problem. Of course you do credit checks. And I mean, the guys chartering these things, it's been integrated oil companies. It's not like, Kuppy's hedge fund chartering a vessel. Like,
yeah.
Although Kuppy's hedge fund tried to buy some vessels, I'm sure.
No, we actually never did that. A very good friend of mine runs a much bigger hedge fund than me, and he actually bought some at the bottom of last cycle. And he said, Kuppy, you wouldn't believe this. Like, we're smart guys. We've done, restructurings in Africa, and we've gone bankruptcy court in some of the worst places on earth. He's like, we couldn't figure out how to make money in the shipping industry. It's just too corrupt. It's too hard. And
there you go.
If he can't do it, I can't.
All right, so Kuppy, let's talk some nat gas, so natural gas has been muddling along the bottom here, but some of these nat gas stocks are moving. What's your take on this whole thing?
Well, I mean, I think it's pretty obvious that this winter nat gas is going to be much higher. I mean, you look at Feb gas, and it was over 3 yesterday, and it's backed off to 298. But the strip's very steep. People are starting to realize that you're going to have a deficit, and it's going to be somewhere between 5 and 20 BCF, and that really should add some profits for some of these guys, even the guys who are mostly hedged. You look at a lot of these stocks are down from 30 and 40 to like $1, and I think they've made back a little bit of the move. I've had a lot of doubles and triples in the last 2 weeks, which is great for me. But,
like that.
No, I think you're early in this trade still. Though that said, I took some off.
So, Kuppy, why don't you tell us the names that you like? What are you trading? What do you like?
Oh, I like Sandridge a lot.
All the way from 17 down to 1, right?
My basis is like 3.5 now, but I'm a terminal bag holder in that. But I mean, look, it's the most levered play to what happens in nat gas. They have no gas hedges. So if gas spikes, they do well. There's a bunch of pipelines just came online, which means that their transport costs are going to drop there quite a lot. And besides, you don't have to actually pay for the gas. The great thing is that their headquarters building is worth the market cap. And so you're really just getting one of the larger gas producers in the United States for free, because I mean you're really just buying an office building in Oklahoma. It's like a REIT, but it comes with some gas on the side. But I mean, look, if you plug in $3 gas, you're making more than $100 million in cash flow, and $4 or $5 gas, you're making like $200-300 million in cash flow, which really isn't that bad on a $50 million market cap. And remember that market cap's covered by an office building.
So
Nice.
So I see that you're in some esteemed company. You got Carl Icahn is the number one holder, and then there's BlackRock, which is obviously an index, but then you have Guggenheim, which Scott
That's probably an index
actually,
too.
You don't think that's minored in the guys actually finding something that they can buy?
No, I bet you that's an index. But I mean, Cannell is pretty smart. He owns this. Rentec
right.
doesn't know. Rentec doesn't know it owns it, but it owns it.
That's a Kuppy line if I've ever heard one.
Well, I mean, you can see Simmons being like, "Why do we own this piece of shit?" I don't know. The computer said to buy it. We bought 1 million shares.
That's funny.
What other names do you like? I think you trade RRC as one of your favorites, right?
Yeah, I own some RRC. I mean, look, I paid 2.25 for it. It's 5.25. I bought some Antero at 85 cents, and it's basically tripled for me. I bought some Gulfport at like 45 cents, and I mean, I sold all those. But I mean, it was a 4-bagger, and like I bought it at 45 cents, knowing it was insolvent, and 2 weeks later, it's still insolvent, but the market cap 4-bagger. Like at some point, you have to look at this and be like, why do I own this crap?
All right.
And so how do you think that this bull story is dependent on lots of people getting shut in terms of on the oil side, which then has the kind of the effect of gas also being kind of shut in?
Yeah, that's exactly the thesis. You're going to see a lot of guys shutting in wells just because there's nowhere to put it. That's my shipping thesis. And then, on the other side, look, oil price is super low right now. No one makes money doing this. I mean, no one made money at 50 either, but they really don't make money at 15. And so they're going to stop drilling, mainly because the bankers are telling these guys they can't drill anymore. And, you're going to see less production. Like we lost another 60 rigs today. I mean, this week, we've been losing about 60 a week for a few weeks now. So all this production is going to trail off. I mean, we even lost 3 in the Marcellus this week. So,
Right.
No, I think this is a great way to play it. I'd throw one more out at you. I like Goodrich a lot.
What's the
And I
symbol
own some
there?
of that. GDP.
GDP. Okay, there's your names. Now, Kuppy, we got to talk about negative oil prices. In your wildest dreams, did you think that would happen?
Yes. I've actually been telling people I thought that, well, when you look at the glut and you look at how bad the glut is, for my tankers to be earning what they're making, someone else has to be losing it. It's it has to balance. And, when you look at the oil price, that's just the cost of storage. I mean, that's the contango, that's the steepness. And if you look at how much my tankers are making and how much they're going to make in the future as charter rates go higher, like it forces the price of oil negative. The math doesn't work otherwise. So I always thought it, but I didn't really want to say it because it sounded so ridiculous. but then
remember when negative interest rates sounded ridiculous too? It's anyway.
I do think that the CME opened a can of worms that they never probably expected or understood, because now all of a sudden you have you've completely thrown what used to be kind of the belief that you were stopped at zero as a holder of an asset. You actually can turn an asset into a liability, which basically means that if you're sitting there as the ETF, let's just say the administrator for the USO ETF, you used to think that your assets could only go to zero, so you were limited in terms of your liability. Now all of a sudden you could actually be on the hook for negative equity.
It's kind of crazy, right?
Yeah.
Well, you had a great post on this, just what the risk is. And actually, quick question: you guys know the quants and you guys know the Greeks. What's the Greek symbol for negative? What's the Greek? How do you plug this in?
I don't know, but you do. It does mess up a lot of like option pricing, and because don't forget, option pricing was always based upon log normal distributions, which was assuming that you were stopped at zero. Now all of a sudden that's no longer the case.
And below zero, I think your tail starts getting sort of fat and very long because if you don't stop at zero, the margin call is kind of like it's like a snowball. It just kind of goes exponential. It's kind of why we went to -1 and then -40 on one tick. Because everyone had a margin call.
It was so dumb. And the reality was it was just for 8 hours it was negative? Maybe 12? I don't know. It wasn't very long. And in doing so, they've opened a can of worms. And it's not like the exchange in times of past hasn't arbitrarily decided to settle something, based upon their own decision. Like the Hunt brothers, when they cornered silver, they had no problem saying that, they were going to arbitrarily pick a number that they were going to settle everyone on cash. Why didn't they just go take it to zero and say everyone's getting settled at zero? And that could have...
It might not have cleared at zero.
No, but they could have forced the clearing at zero. They didn't need to clear it. They could have said, this is it. It settles at zero.
No, but here's the problem, okay? You have you basically have a delivery that has room for 10 million barrels, and 100 million barrels are getting delivered. So I'm a producer. I'm short. I sold. I'm legally allowed to deliver into this Cushing, okay? So I go and say, well, I'm hedged. I'm off to the beach. Well, what happens if suddenly I can't deliver to the delivery destination? My oil's already at Cushing or on the way to Cushing. That's the problem. You have 100 million barrels going to a place, and you need someone at some price to divert that oil to somewhere else that has room. And I don't know if at zero you would have cleared because you'd have 90 million too much.
No, you wouldn't have cleared. But the thing is, what you would have done is you could have solved that in the actual clearing mechanism. And then when they actually went to clear and then they failed on it, and then you could have fined people at that point. And therefore, you would have made it so that the commodity was never worth negative.
Yeah, I'm sure there could be a workaround, but
yeah. Anyways, I think it was a bigger can of worms than most people believe.
Yes.
Like I really do. I think it was really, really short-sighted on the CME's part to do it. I don't think that and especially since it was basically one day of negative pricing, and we're going to forever change the way that we have to price all these things.
Well, after that happened, I had some gold futures on. I booked those gold futures. I want to be long gold, but I'm terrified that if, the next time we have a delivery in, oil or cotton or God knows what, it prints negative again. You might get margin calls that cascade across every asset class with the futures because most of these CTAs have multiple assets. And, you buy your oil future at 10 that morning, expecting you're going to risk at most 10 points because it can never go zero. And it turns out you've risked 4 times more. Then suddenly you have this giant margin call. It cascades through gold. And why can't gold trade negative too?
I don't know if it was going to. I don't know if it's going to go down that much, but I was worried about the clearing firms that night because it was something like $5 billion of risk transfer that had happened. There was a lot of open interest. So in essence, what all those margins, and you're absolutely correct, usually margins go up into delivery, but nobody's going and asking for margins of 200-300%, which is basically the amount that it moved. Right? Like it was absolutely insane. And this is the point. They just they should have never allowed this to happen. It was just an abomination, in my opinion. Abomination.
Right. Here we're sitting with crude oil at 250 implied vol in the front month. Just think about that. Think how nutty that is. I've never seen crude above 40 vol.
Yeah, you and I have talked about this a lot in terms of how many things have broken since we've kind of the coronavirus has come. It started off with GDX trading at a discount to the NAV. Then it went on to different other ETFs. It eventually went to gold futures. Gold futures were $60 premiums to.
They're still 20.
Yeah, they're still 20. And this is the problem, is that the financial markets are more broken than we think. It's just that now some of the breaking is happening on the upside, so people aren't as upset about it. USO for a while, that ETF was trading at a 80% premium because all the
Well, it's
Robin
been
Hood
halted for
traders
2
were too.
hours now.
Yeah, but it was all the Robin Hooders were buying it. Actually, that's another good point. I've been thinking about this a lot, and I think that the kind of popularity of the USO caused the bid in the oil market to be higher for longer than it should have been, and in doing so, it took out a valuable signal that oil producers had. They didn't realize that the clearing price was actually much lower than we expected. Because there was so much demand at the front month that it looked like it was better than it was. And then once they got out, there was no bids, and everyone went, holy shit, where are the bids? And it was like, the bids ended up being minus 40 or whatever it was.
I mean, it's crazy to think that one ETF at one point had 60% of the open interest in front month. I mean, at that point, you become the market. ETFs were great 15, 20 years ago when they were a couple basis points on the market. Now they are the market. I mean, the USO role is the market now, and it's propped up the front end. And it's one of the reasons why my tanker trade is going to be so good, because oil guys are looking at this and saying, okay, front end 16, sure, whatever. We don't make any money there. But, you go back a little on the curve because right now, USO is buying Augies. 24, sure, let me hedge that. I might be losing $5 a barrel, but there's a cost to shut it in. So I'll just lose $5 a barrel. It'll be a month or two. I'll just keep producing. And once you lock it in at 24, you don't care about delivery. You don't care about, anything else because you have a clean line into Cushing and it's someone else's problem. And, I think you're going to end up with this glut being a lot bigger because less guys are going to shut in than what should happen.
Right. All right. Harris or Kuppy, what anything else you want to leave us with? What's on your mind, or is that enough for today?
Well, I guess one more. So I've been thinking a lot about this whole Corona thing. I want to bounce this off you. Sometime in May, they're going to let us out of prison, hopefully.
They already let you out. You're in Florida.
No, so you want to know the stupidity of this, okay? If you want to know why Manhattan has such bad coronavirus, it's because these idiots packed themselves into subway cars. They still are. And they all caught it in the subway cars. I mean, that's why it's bad. If you look at most of the states, most states have under 100 deaths. They all have about 1,000, 2,000 cases. It really never went anywhere. And it's just New York because they're all in subways. Meanwhile, here in South Beach, they'll arrest you if you touch the sand. So you can go walk on the beach walk or the bay walk, but you can't actually go to the beach. Meanwhile, all the studies seem to say that sun kills the thing. So, I mean, it makes no sense. But what do you guys think will happen? Will you guys actually go out of your homes? Are you going to go, out to dinner? Are you going to go out to see your friends? I've been polling my friends, and I've actually been surprised by the responses. I mean, do you think people are going to try to get back to normal pretty fast?
So I think, first of all, as Canadians, we're going to be a little bit behind you guys. We're going to sit there and watch you guys go out and try it out. And I
try it out.
We'll see how it goes, and we'll see from there. But are you asking, like, from a social perspective, whether behavior has changed and how long it'll take for us to?
Are you going to go to? You guys going to go to a crowded stadium? Are you guys going to go out to dinner? I mean, are you going to go to a movie theater? Like, what's your threshold for interhuman interaction?
Yeah.
Where you're like, hey, that might be a little too close.
So for me, it ends up being that if I had no family, like if I was a single guy, my answer would be a lot different. Because then I'm just taking my own chances, and it was no big deal. And if I end up rolling the dice and I get sick and die, I've made that decision. But unfortunately, being a member of a family, I'm making a decision for someone else because then I bring it home. So I'll unfortunately probably have to listen to my wife and just get it. I'll do whatever she tells me.
Yeah, that is a big thing, right? Like a lot of single people will that live at home are going to have a very different attitude than people that live with larger families, because then you have to make a decision. Yeah, I agree with Kevin.
Yeah. So, but why don't you tell us, Kuppy, what your feedback has been and what you think? I take it you're coming about this to the point that you're saying most people are not going to go out, and that this has permanently changed our attitude, and the economy is not going to come roaring back as much as we think.
Exactly. I was thinking I'm going to do a pub crawl with all my friends, and I circulated an email to all my friends here in South Beach. May 15 pub crawl, start at 10 a.m., and we just keep going until we go. And I start getting these emails back from my friends, hey, my wife says I can't, sorry. Can you like FaceTime me at the bar? It's just kind of like, what? So I'm just like bunch of pussies. And then my wife's like, hey, I heard about this pub crawl. You can't go on that thing. And I'm like, what? Like, I'm organizing.
You heard about this pub crawl. You were the organizer of it.
like if my wife had checked her email, she was invited. but instead she heard it from one of her friends, and she's just like, you can't go on this pub crawl. It's like, oh shit. So I think there's going to be I don't know exactly where the line is drawn. I like to travel a lot. I like to go on airplanes a lot. Like, I'm definitely not getting on an airplane anytime soon. I mean, going out to dinner, yeah, I'll probably go out to dinner. But then you have the question, like, is the cook going to get you sick? Is the waiter going to get you sick? The guy next to you going to get you sick? Maybe we'll only just do like barbecue outside. I don't really know where you draw the line, but I think a month ago, my view was everything goes back to normal the day they jailbreak us. And now I think it probably takes a lot longer and it goes a lot slower. And, you got people like my dad who are just terrified to leave home. I mean, he's 74. And I wonder how this all works its way through.
So Kuppy, I have to ask you that.
Not bullish, put it that way.
Yeah, but here at the beginning of this conversation, you're like, oh, they're going to take the market to the all-time highs there. But like at what point does this financial engineering of making the market go higher versus the fact that the economy is not going to recover as fast as everyone thinks it does? At what point does this divergence converge?
It's Project Zimbabwe. I mean, they have no economy there, and the market went straight up. Look at Venezuela. I guess they have no toilet paper either. I gave you that one last time, but it just keeps going up because they print money and they intervene in the market. And I think they're going to keep printing money here. Like, I've taken some exposure off. I wrote about it last week, and on the way up, I'll probably just keep slowly degrossing, just because as I talk to more friends and as I see what's happening. Look, you have 25 million people without jobs. You have a bunch of people that, I have money, but my wife says I can't spend it. Like, what am I going to, like, so, look, I went to a very good friend of mine's house last week. I kind of snapped. I'm just like, I need to go see humans. And I get to his place, and he's like, actually, my wife and I talked, and you're not allowed indoors. It's like I'm like not housebroken or something, And he's just like, no. We'll get 2 lawn chairs. We'll sit in the front yard and pound a case of beer. I mean, these are grown adults, and his wife wouldn't even come outside to say hi to me. Like, she's just like, I'm terrified.
Yeah, no, Kuppy, I tend to agree with you. It's going to be a long time. And one of the things that I'll just give you a little pushback on your idea that we're going to new highs and the Fed's going to keep printing. I think the Fed's going to go and start to realize that as they have stopped the crisis and actually caused a bubble, they will pull back. I think they've already pulled back, and they're going to do less QE each week, and it won't take long before they're starting to pull back to the point where stocks start sagging, in my opinion.
Right, and I think that's why stocks have gone up slower. But at the same time, who's going to do all the PPP? Like, you look at this payroll protection program. You guys don't have that in Canada. They handed out $400 billion, and it turned out about 5% of the people that applied got what they wanted. And the program probably, if you look at it, we have a 20 trillion economy. The economy's been knocked out for 2 months now. So you probably need like 4 trillion of PPP. So they came in at 10% what they needed. I mean, if they come in for the full 4 trillion, I think stocks just go roaring again. That's just so inflationary and so stimulative. And they're going to have to, because everyone's going to go bankrupt. You can't have every business fail. Like, we're going to go back to the Stone Ages here. So, no, I think they're just going to keep printing. They're going to give people money and pay people, whatever. But, yeah, this could be a slow road back. And, as I keep looking at my portfolio, the only things I feel super strong about right now are tankers, obviously, nat gas, and gold.
Right. Well, there you go. That's a great one to leave it on. Tankers, nat gas, and gold. It's the trio for the weekend. Kuppy, it's been a pleasure having you. Stay safe, and we'll see you next month.
Sounds good, guys. Talk soon.
All right, take care. So it's time for Kevin's favorite part, talking charts. But This time, it's not me that's going to be talking charts. We have the pleasure of being joined by Rob Koyfman from Koyfman Charts, who, well, Rob, you sent me your piece, and you were making a pretty solid bullish argument on the markets. And, well, I'm bearish, and you're bullish. And I said, well, we got to bring you on and hear your bull case. So I'd love to have you take us through your charts. And what are you thinking here, buddy?
Cool. Yeah, sounds good. So let me tell you that. So first of all, I wrote up the bull case in a blog post on koyfman.com/research, or if you're looking at it on the web, there's a little blog link right here, and you could click on that, and you'll be able to kind of see what I wrote up. So let me just tell you kind of like where this comes from. I started trading for like actively trading a couple of weeks ago after taking a break from the market. I was on Wall Street for a long time in macro land and equity land, worked at hedge funds on the sell side, buy side. And really, I started trading over the past couple of weeks because I couldn't stay away. And I'm sitting at home and I have a little bit more time than usual. And my predisposition was to be bearish, right? And it's very obvious why you should be bearish with all the negative things going on and obviously the shutdown and the macro and stuff like that. So I was trading with a bearish view. And over the past couple of weeks, my trades, my portfolio just was not acting the way I was expecting it to act. And even though I was long short, I was long tech and short some other stuff, I just was not making any money and kept losing money, even though it's just like the thesis, the bear thesis is so obvious. So I went back to the charts and I looked at all the charts. And when I looked at the charts, I was like, holy crap, every single chart is bullish now. And I had deja vu from 2009, when in 2009, everyone was bared up to the max and every single chart started flipping bullish. And let me kind of like show you the charts that I started looking at. So sure. The first thing was I started looking at all the kind of like cyclical assets. So like IWM, right? So IWM bottomed obviously around March 23rd. Bounced back, and now it's the theme here is higher highs and higher lows. That's the definition of an uptrend. So kind of higher highs, higher lows. That's that's kind of like a very broad index. The next one I started looking at was much more cyclical, which is the transports. Transport, same thing, bottomed, making higher highs, higher lows. Obviously, this trend has only been happening for a month, but it's definitely happening. Then I went and looked at the individual stocks, right? So I went to this lots of charts analysis. I put in transports. And what this does, it shows me all the stocks within IYT, which is the transports ETF. And I look at it on a 1 year basis. And you can see here the largest stocks. These are railroad stocks, UPS. They're all making higher highs and higher lows, right? Particularly the railroads, like making these really nice consolidations and breakouts. Obviously, the airlines are not making higher highs, higher lows. They are moving sideways. So that's the one area of the market, and we could talk about that in a second. But most of the stuff is making higher highs, higher lows. The most important asset that I follow in these turning points, in these kind of to inform me of what the market views in terms of cyclicality, is Freeport-McMoRan. So Freeport-McMoRan is one of the largest copper miners in the world. And the reason this is important is because not only is copper the most cyclical commodity out there, you have a company with operating leverage that's mining the most cyclical commodity in the world. So this chart tells you a lot about the market's view of cyclicality. And when I looked at Freeport, I see this really amazing bottom, consolidation, breakout, consolidation now. They actually had earnings and they're near the top now. This is one of the most important things to watch right now. If you're bearish, you might be right. Like I have no idea what's going to happen going forward, but I will tell you that if Freeport keeps going up, the bear case is null and void. And what's really interesting about the bull case here is that you have a pretty tight stop. So the bull case is out of consensus. You're sort of saying that things are going to normalize faster than people expect. And if you're wrong, Freeport is not going to make higher highs and higher lows. It's going to break down, and probably this kind of clear support at around 720 is going to break down. So it's a really, really important level to watch. Another way to look at it is versus the market. So if you look at it on a relative strength basis versus the SPY, this bottomed exactly around the time of the market bottom. which is, let me just pull this up a little bit over here. So these bottomed at the same time. So this is Freeport and this is relative. If you go back and look at 07, 08, so if I go back to 07 here and I look at 09, very similar dynamic, right? And actually, let me pull up SPX here so you could see SPX here. Sorry, I'm just set this up to show how it's done. So this is Freeport. This is Freeport on a relative basis, and this is SPX, right? And you could see here that that Freeport bottoms here relative to the market. It bottoms here, and the market bottoms about 2 months later. So this is an uber cyclical stock that when it bottoms and starts making higher highs and higher lows, you need to pay attention because something is changing. And what the market is telling you right now is that something is changing. So the question you're going to ask is, well, how the hell can you be bullish when the fundamentals are so overwhelmingly bearish? When there's high unemployment, the economy is closed down, we have no idea what's going to happen to the virus, on and on and on. I don't think I have to explain the bear case to you. And the bull case for that is that equities bottom around the time that the growth or the change in fundamentals is at its worst. So the way to show that is for SPX, I'm going to just go back to 2009. For SPX, if I compare it versus NFP numbers, so this is non-farm payrolls, and I go back 20 years. S&P bottoms around the time that non-farm payrolls are at their worst, right? So the hardest thing about calling these turns is you have to buy at the worst time, because what the market is trading the future probability and not the current situation. And if the future is getting better, the market will get better. I'm just going to throw in initial claims because obviously that's the thing that everyone's watching here. So that's IJC USA. Same thing on initial claims. This is a monthly series. This is a weekly series. This is a monthly series. Initial claims are at their worst here when the market bottoms, and NFP is at its worst as well. If you fast forward till today, initial claims are, obviously we all know they printed 6.5 million, 5 million. They're still printing bad numbers. The question becomes, what's going to happen through June and July? Is this number going to go up or is this number going to go down? And my bull thesis is that even as bad as the situation is right now, this number is going to go down. And to the extent that this number continues to go down, doesn't mean that it has to be positive or the world has to be in la la land. But on the margin, if this gets better, the market rallies. And that's kind of the bull thesis right now. The last thing I would say is to play this trade, a lot of ways to play it in equities, just long equities. I think IWM is an interesting laggard to play on the upside because it's so cyclical. I think tech will do well, S&P will do well, blah, blah, blah. But I think the short bonds trade is super interesting here because my bull thesis cannot work if bonds don't sell off, because bonds are not implying that there's going to be any nominal growth. So when we look at US 10-year.
This is a part where Kevin's getting excited, by the way.
I know. I was like listening, silently going, this is my kind of talking charts.
This is, so if I am right that the world is getting better and there's going to be reflation based on all the things that I mentioned, there is no way this is priced correctly. There's no way. And if you look at historically, if you look at the Fed balance sheet, right? If you look at this is the Fed total assets, and let me just put this on another chart to make it a little bit easier to see. If you look historically, whenever the Fed starts QE, right? And QE obviously let me back this up. QE is obviously when they're buying bonds, but because the Fed doesn't have a monopoly on the long end, they're just one of many participants. This reflates the economy, right? So whenever they're buying bonds, bond yields go up, right? Here they start buying bonds, bond yields go up. Here they start buying bonds, bond yields go up. You're in a scenario here where the Fed just bought more assets than they've ever bought by a factor of 6x. And if their reflation, if their strategy doesn't work to reflate assets, then my bull case is off, and this is going to stay down here. But I think over the next 4 weeks, bond yields are going to make a massive move up if the world keeps getting better. I'm sorry I got so excited. I'll shut up now and hear from the bear.
No, Rob, it's my kind of excited. I like it. I like the talk. And, you're in good company with that. Not only is this Hudler believing that QE causes the long end to sell off, but Stanley Druckenmiller has gone on about that numerous times, how quantitative easing is not bond bullish, and in fact, it is bond bearish. And that is contrary to what almost 95% of the people believe on Wall Street. But if I have the choice between listening to what 95% of Wall Street tells me and Stanley Druckenmiller, I'm choosing Druckenmiller any day of the week.
Look,
absolutely.
QE is inflationary, and bonds have to price that in. But the thing is that right now, the money that the Fed is pumping in is just barely offsetting the deflationary impulse that has come from one of the greatest economic shutdowns we have seen on a global scale. If they're printing QE for the next 5 years, of course it's going to be bond bearish, and it's going to do that. But I mean, if they stop as of this moment providing more liquidity, then they just offset what was the damage done. I don't think there's any inflation impulse if they stopped QE right now. I'm just saying, that thesis that you guys have would have to mean that they're going to just keep going with this. No?
Yeah. 100%, and they are going to keep going with this. So that's absolutely part of the thesis. So, in a normal recession, right, what happens is the fundamentals get worse, liquidity dries up, asset prices start going down, and the way the Fed helps is they come in and they start pushing the other way. And typically they start pushing the other way with lower rates. And then in the last cycle in 2008, obviously they started pushing the other way by doing QE because they ran out of lower rates. They were at the zero bound. So the question becomes now, sorry, just one last thing. Question becomes now, is this kind of the normal gradual easing, or was this way more than kind of the normal gradual easing? And I have no idea. To me, $1 trillion, $2 trillion, $5 trillion, $10 trillion, they all sound like the same thing. I have no idea. I'm not an economist and I'm not a policymaker. All I can tell you is that this is 6 times bigger than anything that has ever been done. It was done immediately. It wasn't done gradually. It was done immediately. They've shown that they're going to do more, and they just did more this week. And the other thing, which is the most important thing, is that the assets that I'm watching, which is those cyclical assets, the reflation assets, they're telling me that it worked. That's all I need to know is that a stock like Freeport is telling me that it's working. So I have no idea if this is enough or not enough. To me, what you said sounds very plausible, that hey, we've never had an economy stop for two quarters. And I get that, but we've also never had a money printing job from the Fed, from the ECB, from the BOJ, from the Bank of England, from the Canadian Central Bank. And what the risk assets that I'm watching, which are the most important risk assets, are telling me that it is working. And that's kind of where I fall into my position.
Well, my pushback on you is not going to be technical. I mean, first of all, I see rising wedges. So to me, the vulnerability is still to the downside. But I honestly think that everyone's counting on the Fed to do more than they will. I think the moral hazard of the fact that Main Street is going to suffer immensely through this entire thing. And if they pump up so much liquidity that they drive the S&P 500 back to all-time highs and bail out Wall Street while Main Street is suffering, they're done. I personally think that the Fed put in the liquidity needed to prevent the system from collapsing from the shock. But I don't think that liquidity is going to be there as long as everyone's hoping. So I'm going to take the other side of that. We'll see. I mean, listen, that's what makes a market. Well, we'll meet in the machine.
So look, I definitely can see someone saying this is a wedge, right? So kind of this is going down and this is just consolidating to break down. I could definitely see that argument. The other thing that I wholeheartedly agree with you is the Fed is widening the divide between Wall Street and Main Street. So they don't really have a choice right now because they have a hammer to fix a light bulb, and that's not a very good instrument to fix a light bulb. But they don't have another choice except to just print money to inject liquidity into the system and drive asset prices higher. And what that's going to do is that's going to widen the gap between rich and poor, between Wall Street and Main Street. And again, I I'm not a policymaker, so I'm not taking a view whether that's right and wrong. I'm just observing what's going to happen, and they almost can't take it away the liquidity. If they take away the liquidity, it doesn't do anything to help Main Street. Sure, it helps with the gap, but it doesn't help Main Street, and it doesn't help all the all the things that support. So again, I think the bear case is very compelling here, and believe me, I was in your camp 2 weeks ago. I'm just seeing some signs that the market is saying that the bears are wrong, and I'm a little bit early, but I kind of lay out what I'm looking at, and I very well might be wrong.
All right. Well, Rob, I had to say you were doing some pretty kick-ass shit on this charting software. Like that's a lot of awesome stuff. It is still free right now, but why don't you tell everyone a little bit more about Koyfman, how they can use it, and what do you have planned going forward here?
Yeah. So Koyfman is a financial data analytics platform. As you said, totally free right now. Just go on koyfman.com. You could see some of the assets that we cover. Definitely a little bit more equity focused than other things. But one of the reasons I started Koyfman is because I thought there wasn't a real accessible product that had a bunch of macro data, a bunch of cross-asset data in one place outside of Bloomberg. And so that's why our platform has equities, ETFs, mutual fund, indices, bonds, Forex, futures, economic indicators. And we built these kick-ass dashboards where we could browse the market according to different assets. So if you wanted to look at the fixed income market, you would go in here, look at the yield curves or global yields, and you could see everything we have here and just kind of see what's going on. Koyfman is free right now. In the future, kind of at some point later this year, we want to have the best free product out there, but we will have a paid tier for a subscription. And the paid tier will have more advanced data, customization, better analytics, but we'll always have a free tier. So don't be kind of afraid if you want to try it and you think it's going to get locked up in a couple months. You'll have access to any of the charts or any of the dashboards that you create on Koyfman. So definitely encourage you to try it. We've had a really nice run recently. We've tripled our user base over the past several months with the help of a Market Huddle podcast. And I think with a lot of people being home looking for alternatives to their Bloombergs that they're sharing with a bunch of people or whatever. So we have a lot of good momentum. And so I hope we can help your workflow and really analyze the markets in a better way.
Well, that's awesome, Rob. Thank you so much for joining us and sharing your ideas. We'll find out. We'll have to have you back, and we'll have to keep score. Anyway, Rob, thank you so much, and we'll talk to you later.
All right, sounds good. Thanks, guys. Bye-bye.
All right, cheers. This week in trading history, Kev.
This week, okay, so you want me to do it?
All right, go for it.
So that was it. Okay, Patrick, it's my second favorite part of the show because I get to just sit back again and just listen to you tell us about this week in trading history. What do you have planned for us?
All right, well, I'm going to go back to April 24th of 1862 for the Battle of New Orleans during the Civil War. And so in the early history, New Orleans was one of had uninterrupted growth. In the 1850 census, the New Orleans ranked as the sixth largest city in the United States with a population of like 168,000 people. And it was the only city in the South with over 100,000 people in it. And it was instrumental in providing military supplies to thousands of troops of the Confederate States Army. But so why financial history, right? Like that's a Civil War thing. Well, it ended up that it was a lack of access to hard cash that played a critical role in the downfall of the Southern Confederate Army. In the beginning, the Treasury started raising money to sell bonds to its citizens, but there was only a finite amount of liquid capital in the South. So it ended up allegedly turning to the Rothschilds, hoping,
with their wee beady eyes,
hoping that the great financial dynasty could help them beat the North the way they helped the British beat Napoleon. And so in the end, the Rothschilds decided not to back the South because they were a bad credit risk. Right. And so Southerners had an important edge. And so let's talk about this history a little bit. So they had cotton, which was their largest export. And so they used this to their advantage as collateral for cotton-backed bonds. So out in Europe, French firms started issuing them, and they were received very well both in London and Amsterdam. So they were issued in sterling with a 7% coupon, 20-year maturity, and they were convertible to cotton at a 6 pence a pound.
You're kidding.
Yeah.
Nice. I like it. Like
right?
cotton-backed bonds. I love it.
It's fun. And so though things were going bad for the South during the war, the bonds actually did very well because the cotton prices were skyrocketing during the war. And so the bonds at one point it actually doubled in their price because cotton was just soaring. And so, but one of the reasons it was soaring is it was a little bit of a fun story. First of all, the port of Liverpool in England was the main place of import for cotton to the British textile industry, and more than 3/4 of all the cotton they import came from the South and of the United States. And because of this, many suspected that the British would actually back the South and bring them into the war against the North. So the South actually put on an embargo on the cotton exports to Liverpool, and this became one of the key precipitating factors in the famous Lancashire cotton famine, which saw over 50% of the workforce laid off and created all sorts of controversy. And it was all because for the purpose of trying to bring Britain into the war on the side of the South. And so winning the war meant keeping the supply of money coming with predominantly through the issuance of these cotton-backed bonds. So everything hinged on one underpinning factor, the fact that investors should be able to take possession of the cotton under the circumstances that the South actually failed to make an interest payment. And so the collateral, of course, is only as good if investors can actually get their hands on it. Right, Kev?
Right.
And so this is why the fall of New Orleans was the financial turning point in the Civil War. Because with the Union controlling the ports and imposing a huge naval blockade, the bonds became massive speculations, and the cotton tap was shut off. And this led to the Confederates having to print money to fund the war, which created inflation and huge devaluation in the currency. So they had collapsing economy, huge hyperinflation taking root, inflation like north of 4,000%. And so in the end, the Rothschilds ended up being right. The South was a bad credit risk, and all of those ambitious bond traders in Europe got tagged. Those cotton-backed bonds were a huge gamble, and in the end, they became worthless.
Wow, that's some great history. I had no idea. You know what?
Yeah.
They got to make one now. Someone should make one that's convertible into gold, or maybe crude oil. Somebody should write a bond now that's convertible into crude oil.
Yeah,
And then you would owe money for the bond.
All right, let's move on. So it's time for...
I have a question.
Oh, there we go. Lena's popping on. What's up?
What?
Yeah, I have a question. Is it New Orleans or New Orleans?
Oh, there you go. Lena sounds like she's been there before.
Yeah, I've always...
Because I know that we're going to get scrutinized about our pronunciation.
Well, there we go. We've been called out. Thank you for the correcting us there, Lena. All right. Let's get to my favorite segment here. WTF Clip of the Week. Kev, what do you got in store for us?
Well, I have PIMCO's or ex-PIMCO's Mohammed El Arian is going to go and visit Santa Clarita. So let's play the tape.
Act casual. Our life was amazing. But something happened to my wife.
I can't feel my heartbeat.
What?
PMIs, the earnings, everything. And on the other side, we've got this huge stimulus effort and a government and a Federal Reserve, a central bank that essentially say, we're ready, we'll be there to catch you if you fall. What's the approach with those two opposing forces in this market?
She threw up this. I didn't have formaldehyde, so I saved it in olive oil.
That was a crazy amount of vomit.
Well, I'm not a medical expert. It was a huge amount. She's acting different. I can cook that for you, sweetheart.
I'm fine.
Look, John, that depends on every investor's own approach.
My own is I don't feel comfortable betting on moral hazard. I don't feel comfortable betting on bailouts, and I certainly don't feel comfortable on this notion that the Fed is going to come in and buy stocks, regardless of the risk.
Did Mom die?
She is dead and also undead.
Zombie?
I don't like that word. I think it's inherently negative.
I don't like it either.
Let's not use it.
And if it does, by the way, then we will no longer be talking about just zombie companies, which eat away at productivity. And
I do like the way that I feel. I have endless energy and I sleep 2 hours a night. I get so much done.
You eat people.
I know. It's just that I'm so much more confident. I can parallel park in one move now.
Dynamism. We're going to be talking about a zombie market that can no longer allocate capital efficiently.
The undead are completely driven by their id.
But if I can't control myself, then I risk everything that matters to me.
I'm not setting you up to do this alone, sweetheart. I'm not going to bail on you now. We have to kill someone who deserves it. I guess the prototype would be a young, single Hitler.
God, we'd be heroes.
So I think we've got to be careful. I understand why people are attracted by the moral hazard trade. It has worked so well over the years, but that's not something that I am comfortable with.
You guys are not great at this.
From now on, we fuck everything up together.
What kind of realtor are you?
Residential, but commercial on request.
I actually liked that show. It got canceled, but it was actually a pretty decent show on Netflix.
Yeah.
And I'm a big Drew
I never
Barrymore
watched it,
fan.
of course.
I know, of course you didn't watch it. Of course. Like, we know that. But it was it was campy. I liked it. It was good. And I thought when I heard Mohammed talking about zombie companies and zombie economies, I was going to do a Walking Dead one, and I thought it was a little too dark for this period, and I thought we could do something a little funny. So there we go. Mohammed visits Santa Clarita.
All right, let's go on. So, Kev, it's time for the top 3 things to watch next week. But before we do, let's review last week's. And so we were talking about the Bank of Canada and the monetary policy statement. What's on your mind there?
Well, I don't know. In general, I continue to be upset with the Bank of Canada and also the Canadian government. They're just not doing enough. And I actually had this interesting chart the other day that I had that showed the fiscal stimulus for the U.S. versus the rest of the world, and the U.S. is doing twice as much as anyone else. And although I know I'm supposed to be talking about the Bank of Canada, I just think that the Bank of Canada needs to be operating with the federal government, and they need to be doing more stimulus. They need to be doing more. Our economy is in a lot of trouble, and we almost seem like we're Europe in that we can't get anything done.
Right. All right. So number 2, we were looking at whether the gold breakout was for real or whether it was going to be a fake out. And, well, you know what? Gold continues to edge higher. It's pressing along the top end of that range. And, I still think it can go higher. I think we can probably see 1,800 to 1,850. Please don't tell me you're bullish, too, because that's going to goocher it for everyone.
No comment.
All right. Safe. And the last thing we were talking about is whether the S&P 500 stalls out at the 50% retracement levels. You know what? We continue. 2,800 is more or less about a 50% retracement of the entire bear drop. And we continue to hover exactly at that same level. And it has not been resolved yet. Obviously, we heard a pretty good bull argument for Rob. I'll take the other side of it. So we're going to find out in the coming weeks whether this breaks or not. So
It's almost like that 50% retracement actually means something, and those crazy Fibonacci lines mean like actually.
Well, actually, no, I don't think a 50% retracement is about Fibonacci. It goes even back to Dow theory and all sorts of other stuff. It's just about the fact that markets have a natural response in terms of its ebb and flow of the waves. Anyway, let's just move on. Let's go to this week's top 3 things. And Kev, we obviously have these ISM manufacturing numbers, which are going to come in the U.S. and they're going to be shit. But how shit? And will the market care?
They are going to be terrible. They probably could be worse than the worst numbers on record. If let's face it, they close the economy. I don't think it's going to matter. Call me wrong, but maybe.
Well, it's just like the jobs numbers, right? Like they just coming bad, and the market doesn't seem to respond to it. Everyone knows the stuff's coming in bad, right?
Right. So, although the algos still read it and they still trade on it, so sometimes you'd be surprised.
Right. So the next thing I wanted to talk about, obviously we saw a historical oil move, right? And we didn't spend enough time talking about it on the show, which is what happened in May, right? We saw that May contract go to almost minus $40 before a day before it was set to expire. Just unbelievable that happened, right? And but now, so here's the chart of the May contract where that imbalance occurred. But now we're talking June, and the question here is, are enough of these funds and everything rolling forward enough for for us to avoid that front month imbalance that drove it to zero or negative last time around? How do you think it plays out this month?
So, Patrick, I will go out on a limb here. I will say not only is June not going to see a negative number, that $6.50 tick that we got on Wednesday, when the USO puked out a vast majority of their June contracts, will be the low for the move.
Oh, so they already rolled the majority out to July, August?
A lot of them. They rolled a lot of them, and then there was other funds that did the same. They realized that there's too much risk in the front month, and basically the fact that we now have potentially negative prices, especially as we get close to delivery time. These funds don't want to have that liability, so they're trying to spread it out, and they're going out the curve. And in doing so, they blew out June, July, I think went to minus $10. I think that's the low, Patrick. I know, that sounds...
Okay, but no, you know what? Okay, the low on the front month is one thing, but does the contango stay in the curve? Like,
so the contango's going to stay there for a while, because I think that the storage will continue to be an issue. But I will say this: if I'm correct, no contract month will go below $6.50. I think that's it. I think we had this crazy number that was negative on the day of delivery, so I almost don't even count that. I think that $6.50 tick was the obscene real selling of financial or like trading contracts, not kind of actual real in the demand contracts, financial contracts. And I think from here it's going to sort itself out. And I'll tell you this, everyone's going to be looking for negative next month. I think Jimmy Jude said it. When everyone's looking one way, something else is going to happen. Don't forget, oil is your crazy uncle in the corner. And if everyone's expecting him to do this,
he's
drunk
going to
do the exact opposite. It wouldn't surprise me at all if during the next expiry it actually rallies, because everybody's all set up short.
Well, listen, I mean, I personally look. There's a reason oil is cheap. It's because the economy is the thing, and there's this inventory glut. But the negative number and these really low prints are really about financial imbalances in the way trading products were trading, and everyone that got burned this moment is already making the adjustment, so you won't see the same thing happen twice. I'll agree with you that
don't Gucci it. Don't Gucci the trade.
Tell
me I'm wrong, and that 6.5 is going to get taken out.
I'm not going to say anything at all. Number one. Number one, I wanted so we have ECB and Bank of Japan on the stage next week.
Deck.
On
it's
deck.
A big deal.
And now Bank of Japan already announced unlimited QE, which I don't know how much is different than the last 5 years of unlimited QE.
No, I think they technically had limits. It was they wouldn't do. Well, it's kind of complicated because I think that the yield curve control technically has no limits, and then other parts had limits. The Bank of Japan, who knows what the hell they're doing? I think the more important thing is that they're going to go buy corporates, Patrick. Yeah. And then the other thing is ECB.
They've already been buying ETFs and all this stuff. Bank of Japan is like a top 10 shareholder in in almost every stock on the Nikkei on the main index.
Well, they're going to be now top 10 holder on all their corporate bonds.
That's
and then the ECB, this is where the real action is going to be. Do they go and do something stupid and try to fix things with like lower rates? God help me. I sure hope they don't. And that they realize that really what they need is fiscal and or some going out the credit curve with the ECB. Big test for Madame Lagarde. Let's see if she can corral them and convince them to do it. I'm worried, though, Patrick. I'm worried that they don't seem to be able to agree to anything. They go and they have meeting after meeting. This was the fourth meeting that the EU leaders had, and all they managed to do is agree that it was a big problem. Like they're just ridiculous, redonkulous, and they're going to continue to be the laggard of all the economies if they can't figure out how to go and actually spend some dollars.
Right.
It's going to be super interesting. It really. Honestly, if they don't figure it out, then there could be a crisis there. So I think people should be watching the ECB and Europe more so.
Do you think that the euro could break on that news?
Well, if it ends up being that Italy decides that they've had enough of this gong show and that they're going to go out and do something about it, for sure, it's going to be ugly. But what's going to be maddening is that realistically, they're going to take a market crisis to end up where everyone knows they're going, but they should just do it anyways and avoid the whole market crisis. This was the same argument I made about the Fed, kind of when right at the beginning I was railing and saying that the Fed should cut, and everyone's like, why? We have to wait for the numbers. And I was like, everyone knows the numbers are going to be terrible. We just send half the economy home. Like, why bother waiting for the confirmation that everyone knows is the case? And in terms of Europe, if you don't go and spend, then your economy is going to fall. You know that people are going to go into deflationary credit destruction, feedback loop. So why let it get started? Why not get ahead of it? Right. But you know what? I'm obviously not an EU leader in Brussels because they seem to be they operate on a different set of rules than the rest of us.
Absolutely. All right. Well, definitely those are the top three things to watch next week. So let's wrap things up. Now, I saw this parting wisdom out on the Twitter universe, and I just thought it was worthwhile mentioning. But it's always important to remember, information leads to perception, which results in behavior. And what it always is, and whether you're thinking about what happened with oil or anything else, as all this information comes, it is influencing the perception we have of everything. Like, who would have ever thought we would have seen negative oil? Now everyone's pricing that reality in, and it's now changing the behavior. And this is so important in this time frame to always remember, right?
Right. Well, that's some good stuff, Patrick, even though it's done by the Anon group.
Is that bad?
I don't know. Isn't that the crazy guys with the face masks?
Probably
is. Well, let's get Lena on, because Lena's much better at taking us out and doing all the outro,
soliciting people to follow us.
Yeah, that's right. They don't want to follow us; they want to follow Lena. So, Lena, what should you be telling? Well, first of all, let me thank everyone. I'm going to thank, first of all, Chris Sommers for a terrific interview. It was great to have him on. I really love finding guests like Chris.
Oh my God, he was so good.
That aren't on all other sorts of podcasts, but yet have stories to tell that are just terrific, with some great insights, some terrific kind of thoughts that really made you question about how you saw the world, and then some terrific kind of wisdom in terms of his experiences throughout his time on Wall Street. So I really enjoyed that, and the sailing story cracked me up. Then a big thanks to Kuppy. Kuppy's always terrific. This was no exception. Even though he does look like Fat Joe Morrison, he's always a pleasure to have on the show. We love having him on. I continue to talk to Kuppy on a regular basis, and I'm pleased to say we're becoming friends. And I enjoy his time all the time because he makes me laugh on a regular basis. And then finally, a big thanks to Rob Koyfman. He's got a great product, but more importantly, he's got a great thesis. I loved it when he started talking about shorting bonds, and you had to sit there and listen to him talk without saying anything, Patrick.
It was so hard.
I know it must have been for you. It was a big thanks to everyone. A big thanks to Lena. Lena, thank you for everything. Thanks for putting up and doing this extra long show. And why don't you tell people where they can find what we want them to do and help us out?
Well, if they enjoyed this episode, if they can subscribe to our YouTube channel and even maybe ring the bell there so they can be notified once our new episodes are up. And also follow us on Twitter at The Market Huddle.
Oh, okay. And make sure you share the love. If you're enjoying these shows, right. Make sure you let other people know.
Share the love, not the virus.
There you go. That's going to be your line, Lena. Share the love, not the virus.
That's right. Share the love, not the virus.
There you go.
Okay, well, that's great. Thanks a lot, everyone. Okay, so Lena, there was something.
Wait, hold on. You guys didn't do the thank yous at the end. Like, you didn't finish off, like, follow me.
Don't worry about it.
That's for this episode. It's fine.
Don't worry about it. Everyone knows who we are.
You can just even keep this part in there now.
Yeah, that's fine. I agree. Don't edit it out. Just let them know how. What's this ringing the bell? Did we go through this last time and I've forgotten?
Ringing the bell on the YouTube channel.
Yeah.
Basically, when there's a new episode up, like if you're subscribed to our channel and you have clicked on that bell icon on the YouTube channel, it'll notify you once.
Oh, I didn't know that. I got to ring the bell. I didn't ring the bell.
Yeah, that's right.
Okay.
Well, you want to listen to yourself after you recorded it?
No, I never listen to myself. I you know what? I don't. You know that.
Yeah.
I know Patrick doesn't either because he asked me, "Did I fuck up last week? Did you leave it in?" And I was like, "No." Someone commented. I'm like, "Well, you said 2007 instead of 1907." So.
That's funny. So, Lena, I thought you were gonna have some joke you wanted to read. Luke wanted you to read a joke.
Oh shoot! I didn't even have that prepared.
Yeah, you better go prepare.
Well, go figure it out.
While I'll talk while you go get it ready. This is her boyfriend wanted her to read a joke. Thought it would be funny if Lena read it.
Oh, this is the same joke that. Okay, so okay. Let me see here. I believe this was from a listener.
Well, I don't know where we're having some trouble because someone told me it was this economist that was the original kind of originator of the joke, and then I looked and she didn't know where she got it from either. But it's
so we don't know the origin of this.
No, it's going all around Wall Street. So let's just read it because it's funny.
All right, so here it goes. A buddy of mine sent this to me. Oh, never mind. That's not the one. Sorry, I'm gonna edit that out.
No, you're not.
This is the best explanation I've heard why WTI crude oil traded at minus $37. Imagine the following. You pay $500 today and commit to receiving an escort at your house in 15 days because your wife is traveling. This is called a futures contract. Unfortunately, lockdown came and your wife will be home for the next 60 days. Yeah, unfortunately, right? You do not want this woman as an escort to show up at your house at all and try to pass this futures contract to someone else. Only you cannot sell this commitment because nobody can receive the escort at home anymore. Everyone is in full storage and their balls with their wife. To make matters worse, not even the pimp, aka Chicago Mercantile Exchange, has more room to receive girls because his house is crowded with girls. So you will have to pay anyone just to take the girl off your hands. Do you now understand why oil has a negative price when the contract is delivered?
Nice.
This definitely did help me understand what's going on.
It's funny. I sent it to Lena and Lena's like, I get it now.
I get it.
Yeah. I did say that.
She's like, I get it. I get it.
I get it now.
That's funny.
So if you don't get it from this phrase or this story, I don't know how else to explain it to people.
So Patrick, did you listen to anything new?
No.
Nothing? How about you, Lena?
Did I listen to anything or did I watch anything new? I watched, what did I watch? I watched Innocence Files or something.
Oh, okay.
Yeah, it's about people who were wrongfully convicted and who went to prison for like 30 years even though they were innocent.
Oh, okay. I think my wife watches that. She likes
I like crime documentaries, so it was interesting to see how, how the justice system isn't always just, I guess.
Right.
What?
So it's fascinating, but it is kind of scary. You can just get framed, or you can get not framed. It wasn't like on purpose, but if you get indicted for something you didn't do, and you don't have, if you're coming from a low income family or whatnot, if you're a low income individual and you don't have the funds to get a good lawyer, and then you're in the can for something you didn't do, and somebody was on death row for it. You know, like somebody got sentenced to die for something they didn't do.
Yeah.
You know, that's crazy. Yeah. Crazy talk. But let's not talk about that because that's kind of depressing.
That is kind of depressing. Do you watch, okay, I'll do something a little more exciting. Do you watch Bosch?
You know what? I watched the first season like when it first came out, but I haven't gone back to it.
It's like one of our favorite shows.
Is it so good?
We've been waiting for this new season. It just dropped. So we're like halfway through the Bosch. Like we love the Bosch.
Kevin, I think we may have to change the direction of this conversation because Patrick has nothing to contribute.
I know, but he never does.
I never do.
Like basically, all he can talk is charts. All he can talk about is like flying dodgies and stuff like that. You verge there. No, he's good.
I don't know where you find the. I don't know where you find the time to watch TV. Like. I work like 12 to 16 hours. I think I'm a content machine for a reason because I'm working. I'm always working.
Yeah, you are. You do work hard. I agree.
I just don't. TV is just not something that's in my lifestyle.
But what do you do to like unwind?
He goes through chart books
when you want to relax.
He looks for dodgies.
I work out. I go drinking with buddies, which is not so easy nowadays.
Are you drinking with your buddies over Zoom meetings?
Yeah, no, for sure.
You know what, Alina? I'm really embarrassed to say that we do that.
Do you really?
One of my buddies was like, "Hey,
do
you guys want to just like drink together?" And so like Thursdays we go drink, because Thursday's the night to go drinking. So Thursdays we drink. It's not a lot.
That's why you're always in great shape Fridays for the huddle because you had a primer.
We don't drink a lot, and it's like we're old now, so we just like sit around and have a beer or two, and then like that's it. But it's pretty good. It's fun.
I have not actually had any Zoom meetups with any friends. Just like a one-on-one FaceTime. But
Lita, you got to get on it. You got to go. You got to do some social drinking. You know what? We should have a market huddle Zoom drinking. Oh yeah, that's like basically every Friday for us.
Oh my god.
Yeah, I only drink with you guys. You know that, right?
Yeah, sure.
No, it's true. I haven't had a drink unless it's with you guys online when we're recording for Fridays.
Oh my god.
Also because I just don't like to spend money on alcohol.
Oh my god. I don't pay you
So
enough.
we need some sponsors.
I'm a girl. Why should I have to spend money on alcohol?
I know, because we need our sponsors. We need the sponsors.
Yeah. Well, we're working on it.
I know. We're going to get some good sponsors.
Exactly.
I got a good feeling about this.
Yeah. I do too.
We're really taking off now. People are going to see this and they're going to be like, we got to sponsor that show. That's a great show.
All right. I got to get out of here. All right.
Okay. Well,
I'm
have
tapping
a great
out.
weekend. Stay safe.
Yeah.
Take care, and thanks for listening, everyone.
All right. Have a good weekend, everyone. Cheers.
Have a good weekend.